returned the rest, so that Greenblatt and Goldstein could concentrate on managing their own fortunes. Most fund managers are vulnerable to their shareholders' whims, but they had the ultimate luxury of being answerable to nobody. Free to pursue his curiosity wherever it took him, Greenblatt forged an unpredictable path. Many of the best investors have narrow interests, since excellence demands focus. But Greenblatt has led a rich and varied life. For a start, he's an enthusiastic family man with a wife, 5 kids, and 2 dogs. He's also an annoyingly talented writer. He's published 3 investment books, which are filled with his unique blend of granular advice. Irreverent wisecracks? No. There are 3 kinds of people. Those who can count and those who can't. Exuberant wordplay. Ipso facto is spelled ipso fatso. And amusing tales of his youthful misadventures involving imitation, dog vomit, and underage bets at the Greyhound racetrack. His first book, You Can Be a Stock Market Genius, Even If You're Not Too Smart, was intended for a general audience but became a Bible for hedge fund managers in search of an edge. His second, The Little Book That Beats the Market, was designed to demystify investing for his children, but sold more than 300,000 copies and was hailed by Michael Price as one of the most important investment books of the last 50 years. His third book, The Big Secret for the Small Investor, fared less well. Greenblatt jokes that it's still a secret because no one read it. Since 1996, he's also taught the course Value and Special Situation Investment at Columbia Business School. So far, he's instructed an elite cohort of around 800 MBA students, sharing with them the intellectual framework that enabled him to beat the market. Greenblatt begins the course by informing them that the skills he's about to teach can make them extremely rich. But he warns that this pursuit has about as much social value as a knack for handicapping horses. With that caveat in mind, he asks them to find some way to give back. Writing and teaching have provided Greenblatt with 2 rewarding ways of giving back. In a field that's rife with self-serving and misguided advice that may be hazardous to your financial health, he has followed in the grand tradition of Ben Graham, Warren Buffett, and Howard Marks by sharing investment wisdom that has demonstrably worked. Meanwhile, as a philanthropist, Greenblatt has also played an instrumental role in creating a network of 45 free public charter schools that serve 18,000 students across New York City. Most come from low-income and minority households in areas such as the Bronx and Harlem. In recent years, Greenblatt has also returned to managing outside money. He and Goldstein have created a family of long-short mutual funds, which represent an intriguing and unexpected departure from the strategy that propelled them to stardom. Greenblatt, who has a strong entrepreneurial streak, loves starting new ventures. But his underlying ambition isn't to maximize his own wealth by building a financial empire. I have nothing against making money, he says, but it's not really what drives me. I have enough. Rather, he's motivated primarily by a game player's delight in devastating ingenious ways to win. It's the fun of the challenge of figuring things out that I'm most attracted to, he says. And since everyone else in the world is trying to figure it out, it's a nice feeling to solve the puzzle. Indeed, I see Greenblatt as a kind of code breaker who is drawn inexorably to the intellectual challenge of beating the system. I wanted to understand what he had discovered in more than 3 decades of attempting to decrypt the market and outwit the woes of competition. As I would soon learn, the principles underpinning his strategies are surprisingly simple. In fact, what makes Greenblatt such an illuminating guide to investing is his gift for reducing this complex game to its purest essence. For example, during a conversation at his office in Midtown Manhattan, he tells me that the entire secret of successful stock picking comes down to this: figure out what something is worth and pay a lot less. Is it really that straightforward? Well, we shall see. But first, let's take a brief detour to explain why it's so important to identify a few fundamental principles that are, at least, approximately true. Then, with help from Greenblatt and some other financial titans, we'll narrow everything down to a handful of specific investment principles that should help us to stay on track for decades to come. The goal? In this overcomplicated world of ours, we are searching for a simple, logical, and dependable path to superior returns. The simplicity that lies on the other side of complexity. Growing up in London in the 1970s, I could choose from a grand total of 3 television channels. I still remember the magical evening in 1982 when my motherland was blessed by the miraculous arrival of Channel 4, which promised to deliver a limitless feast of televisual wonders. Nowadays, in 21st century New York, I have at least 100 channels, yet I can seldom be bothered to switch on my TV, except for the reliable disappointment of watching England's soccer team getting knocked out of the World Cup every 4 years. We often assume that additional choices will make us happier. Up to a point, it may even be true. But I'm hardly alone in finding all of this added complexity overwhelming. The psychologist Barry Schwartz argues in The Paradox of Choice. Why more is less that many shoppers become paralyzed by the first world problem of supermarket shelves, heaving under the weight of 24 types of gourmet jam. When it comes to investing, the proliferation of choices can make your head spin. Should you buy individual stocks, ETFs, hedge funds, or mutual funds, actively managed funds, or index funds? Should you favor one investment style or mix and match among such categories as growth, value, growth at a reasonable price, deep value, momentum, macro, or market neutral? And how should you divide your money between domestic and foreign stocks, bonds, cash, and alternatives, such as private equity, venture capital, REITs, gold, and pork belly futures? In practical terms, the ability to reduce complexity is immensely valuable. Just think for a moment about the Old Testament, which contains no fewer than 613 commandments. Who can remember so many rules, let alone obey them all? Maybe that's why we needed a top 10 list. But when I tried to jot down the 10 commandments just now, I got only 6 of them right, and that was with the assistance of some dishonest grading. Still, I do remember this. About 2,000 years ago, a sage named Hillel was asked to teach the entire Old Testament while standing on one leg. He replied, "What is hateful to you, do not do to your neighbor. All the rest is commentary." The Old Testament requires just 3 words to convey this overriding rule, V'ahavta l'reacha kamocha, which is translated from the Hebrew as, "And you shall love your neighbor as yourself." Likewise, when Jesus was asked about the most important of all the commandments, he opted for deep simplicity, declaring, "Thou shalt love the Lord thy God with all thy heart, and with all thy soul, and with all thy strength, and with all thy mind, and thy neighbor as thyself." I'm also partial to this wonderfully concise exhortation from the Buddha. Refrain from what is unwholesome, do good. Purify the mind, as an instruction manual for life. How much more do we need than those 10 words, like Hillel and Jesus? The Buddha presumably recognized that we lesser mortals are acutely vulnerable to confusion in the face of complexity, and that a minimal number of simple, memorable guideposts can steer us pretty effectively in the general direction of nirvana. Simplification is an equally important strategy in more worldly realms such as science and business. For example, scientists often invoke the Occam's razor principle, which is attributed to a 14th century English friar and philosopher named William of Ockham. His principle holds that, all things being equal, the simplest solution tends to be the best one. Occam's image of a razor captures the critical notion that we're more likely to find the right answer by shaving away all unnecessary details. Albert Einstein agreed, observing all physical theories, their mathematical expressions apart, ought to lend themselves to so simple a description that even a child could understand them. Lord Ernest Rutherford, the father of nuclear physics, reached a similar conclusion, reputedly remarking, "If a piece of physics cannot be explained to a barmaid, then it is not a good piece of physics." 2. Simplicity also plays an important role in many of the most successful businesses. Take the Google homepage, which consists primarily of a logo and a pill-shaped space in which to type your search words. Or consider the sleek, uncluttered elegance that Steve Jobs, inspired by the minimalist aesthetic of Zen Buddhism, brought to Apple's products. As Jobs often explained, his devotion to simplicity went far beyond design, the way we're running the company. The product design, the advertising, it all comes down to this. Let's make it simple, really simple, as far back as 1977. The company's first marketing brochure featured a photograph of a shiny red apple under the tagline, "Simplicity is the ultimate sophistication." 3. The financial services industry tends not to favor simplicity. Hence the rise of mind-boggling innovations, such as collateralized debt obligations, structured investment vehicles, and credit default swaps, which came close to destroying the global economy in 2008. The late Jack Bogle, who founded the Vanguard Group in 1975 and created the first index fund a year later, observed in a book titled Enough, financial institutions operate by a kind of reverse Occam's razor. They have a large incentive to favor the complex and costly over the simple and cheap, quite the opposite of what most investors need and ought to want. For when I interviewed Bogle in 2001, he pointed out that nothing could have been simpler than his theory that low-cost index funds would be actively managed funds as a group, since the latter would be burdened by higher operating expenses and transaction costs. When there's a financial intermediary, a croupier, it takes a lot out of the market return, he told me. So index funds have to win. It was not complicated. That elementary insight into the mathematical advantages of index funds proved so powerful that Vanguard's assets have since grown to $6.2 trillion. One of the most thoughtful proponents of simplicity is Josh Waitzkin, an expert on peak performance in fields as diverse as chess, martial arts, and investing. As a child prodigy, he was a national chess champion and the subject of the movie Searching for Bobby Fischer. As an adult, he became a world champion in Tai Chi Chuan push hands, a coach to hedge fund managers, and the author of a fascinating book, The Art of Learning, an inner journey to optimal performance. Based on his own experience as a world-class performer, Waitzkin stresses the importance of breaking down complicated challenges into simple components. When teaching chess, he would remove all but 3 pieces, 2 kings, and 1 pawn, as a way of exploring the game's essential principles in a context of reduced complexity. Similarly, he mastered Tai Chi by incrementally refining the simplest of movements, for example, pushing your hands 6 inches through the air. By obsessively practicing such simplified motions, he gradually internalized the underlying principles of the entire martial art, such as the coordination of mind, breath, and body. He concludes, it is rarely a mysterious technique that drives us to the top, but rather a profound mastery of what may well be a basic skill set. This is a crucial insight that can benefit even the smartest investors. After all, complexity can be a particularly seductive trap for clever people. They were rewarded at school for solving complex problems. So it's no surprise if they are drawn to complicated solutions when confronted by the puzzle of investing. But in financial markets, as in martial arts, victory doesn't depend on dazzling displays of esoteric techniques. It depends on a firm grasp of the principles of the game and a deep mastery of basic skills. As Buffett has said, business schools reward difficult, complex behavior more than simple behavior. But simple behavior is more effective. Buffett himself is a grand master of simplification. Writing to his shareholders in 1977, he laid out his 4 criteria for selecting any stock. We want the business to be 1. One that we can understand, 2. With favorable long-term prospects, 3. Operated by honest and competent people, and 4. Available at a very attractive price. These may not strike you as earth-shattering secrets, but it's hard to beat this distillation of eternal truths about what makes a stock desirable. More than 40 years have passed, Yet Buffett's four filters remain as relevant and useful as ever. I've been struck again and again by the ability of the best investors to condense many years of learning into a few key principles. This isn't a matter of dumbing things down or pretending that complications and contradictions don't exist. It's about synthesizing the details of an endlessly rich and nuanced subject, then crunching it down into an irreducible essence. This reminds me of a remark that's often attributed to the Supreme Court Justice Oliver Wendell Holmes. For the simplicity that lies this side of complexity, I would not give a fig. But for the simplicity that lies on the other side of complexity, I would give my life. 6. Why is it so valuable to reduce investing to a few core principles? For a start, it forces us to think through what we truly believe. These convictions are especially useful in tempestuous times when we're beraged by uncertainty, doubt, and fear. Just think how disoriented we felt in the early months of 2020, when COVID-19 killed more than 100,000 people in the United States alone, threw tens of millions into unemployment, and drove the market down by a third in a matter of weeks. But it's almost as easy to get knocked off course in the best of times. There's so much anxiety-inducing noise in the news. So many competing sales pitches from hawkers of awful investment products and dubious expertise. So many temptations to switch to whatever fashionable strategy or overheated asset class seems to be making everyone else ludicrously rich. The best investors have the discipline not to be swayed by such distractions. As Greenblatt says, I have a simple way of looking at things that makes sense to me and that I'm going to stick with through thick and thin. That's it. Will Danoff's secret sauce. The virtues of a simple, deeply held investment credo struck me with particular force when I interviewed Will Danoff at the Boston headquarters of Fidelity Investments. There's nothing slick or showy about Danoff, a genial workaholic with a gap-toothed grin and a wry sense of humor. He looks more like a rumpled, sleep-deprived middle manager than a master of the universe. Still, since taking charge of the Fidelity Contra Fund in 1990, he has built it into a colossus with about $200 billion. It's notoriously difficult to outperform the market with a huge fund, but when we met in 2017, Danoff had the remarkable distinction of having whipped the S&P 500 over 1, 3, 5, 10, and 27 years. I was eager to uncover the subtle ingredients of his secret sauce. But he managed to sum up his entire investment philosophy in 3 words: stocks follow earnings. With that principle in mind, he searches with relentless drive for best-of-breed businesses that he thinks will grow to be bigger in 5 years. Because if a company doubles its earnings per share in the next 5 years, he believes the stock price is also likely to double, more or less. This generalization is easy to dismiss, because it sounds suspiciously simplistic. But remember, investing isn't like Olympic diving, where the judges award extra points for difficulty. Danoff is unapologetic about his single-minded focus on predicting earnings growth. Unlike most of the investors in this book, he doesn't even worry that much about valuation levels, except when they get ridiculous. He asks, "Do you want to win the game for shareholders and own great companies? Sometimes, to own a great company, you've got to pay a fair price." This mindset has led him to amass enormous long-held positions in dominant, well-managed businesses such as Berkshire Hathaway, a major holding since 1996, Microsoft, Alphabet. He was one of the largest investors in Google's 2004 IPO and has held it ever since Amazon. His biggest position, and Facebook, he was among the biggest buyers in the IPO. "This is pretty basic stuff," he says. "My attitude with investing is..." To explain his way of thinking, Danoff shows me a stack of tattered and coffee-stained notes that provide a partial record of his meetings with tens of thousands of companies over the past 3 decades. He pulls out one of his favorite mementos, 2 pages of his messy, handwritten scribblings from a meeting with Howard Schultz, the visionary who transformed Starbucks into a global brand. They met in June 1992. exactly 1 week before the company went public with a market value of $120 billion. Looking over his notes from that meeting, Danoff tells me, everything you needed to know was laid out here. There was a huge opportunity. For example, Schultz pointed out that Italy alone had at least 200,000 coffee bars. By comparison, Starbucks had 139. But the Seattle-based company was aggressively expanding into other cities, opening new cafes at a modest cost of about $150,000 in profits. A 60% return on the initial investment. The key, says Danoff, is that the return on each store was quite high, so the company could grow at a fast pace without needing external financing. Danoff says he didn't appreciate Schultz when they first met, but Starbucks would ultimately become one of the Contrafund's largest holdings along the way. The company would provide the perfect illustration of why it's so valuable to invest for the long run in great businesses that sustain an unusually high growth rate. Danoff points to a chart that tracks the company's stupendous performance over 2 decades. Its earnings per share grew by 45% annually for 20 years, while the stock soared by 32% a year. Over the same period, the S&P 500's earnings grew by 4% a year, while the index rose just 9% a year. Danoff runs a finger along the fever lines on his chart and asks me what lesson they demonstrate. I reply, the stock price is eventually going to follow the earnings. His eyes open wide and he flashes me a joyous smile. Exactly, that's what I've learned. Stocks follow earnings. His mantra doesn't sound particularly profound, but Danoff's edge lies partly in his consistent refusal to overcomplicate. His friend Bill Miller, one of the most insightful thinkers in investing, says Danoff consciously focuses on the questions that matter most, instead of getting tangled up in distracting details. Will once said to me falsely, look, I'm not that smart and there's a lot of information out there. So when I look at a company, I just ask myself, are things getting better or are they getting worse? If they're getting better, then I want to understand what's going on. Miller, too, has learned to simplify his investment process. I'm trying to get rid of the unnecessary parts of what I used to do, he says. For example, he used to build elaborate financial models in an attempt to grasp the complexities of each company he was analyzing. I don't build models anymore. It's just stupid. It doesn't make any sense. Instead, he concentrates on 3 or 4 critical issues that he believes will drive the business. For every company, there are a few key investment variables, he says, and the rest of the stuff is noise. The pattern is clear. In their own ways, Greenblatt, Buffett, Bogle, Danoff, and Miller have all been seekers of simplicity. The rest of us should follow suit. We each need a simple and consistent investment strategy that works well over time, one that we understand and believe in strongly enough that we'll adhere to it faithfully through good times and bad. We'll return to this idea later because it's so important. But for now, let's delve deeper into Greenblatt's mind and find out what he figured out about how to solve the puzzle of investing. Efficient markets, crazy people, and dynamite. When Greenblatt was an undergraduate at Wharton in the late 1970s, his professors insisted that there was no point even trying to beat the market, as proponents of the efficient market theory. They claimed that stock prices incorporate all of the information that's publicly available. As they saw it, the interaction between knowledgeable buyers and sellers results in stocks being priced efficiently at their fair value, which means that it's futile to hunt for bargains. Intellectually, it's an elegant theory, a testament to the collective wisdom of crowds. What's more, it's had the positive effect of drawing many regular investors into index funds. They are built upon the disheartening but realistic notion that, if you can't beat the market, you should focus on matching its returns at the lowest possible cost. For the vast majority of investors, indexing is the most rational and simplest strategy of all. But Greenblatt didn't buy what he was being taught. I had a visceral response to what I was learning about efficient markets, he says. It didn't seem to make sense to me just on a basic level of looking at the newspaper and seeing what was happening. For a start, he could see that stocks routinely experience wild swings between their 52-week highs and lows. If a stock trades at 90 in November, how could it be correctly priced at both extremes? And what about hot stocks such as the Nifty 50 that suddenly burst into flames? For example, did the purportedly all-knowing crowd price Polaroid fairly at 14 in 1974? It seemed highly unlikely. Greenblatt saw that the overall market also lurches erratically from one extreme to another. The euphoric boom and sickening bust of 1972. 74 established a pattern of head-wrenching volatility that he would observe throughout his career. He points out that the S&P 500 doubled from 1996 to 2000, halved from 2000 to 2002, doubled from 2002 to 2007, halved from 2007 to 2009, and tripled from 2009 to 2017. Were investors logically and efficiently setting stock prices as the market soared, stumbled, and swooned? Or were they much less rational than the academic theorists wanted to believe? Greenblatt graduated summa cum laude in 1979 and enrolled in Wharton's MBA program. But his formal education did little to resolve these market mysteries. He took a class on investment management, but failed to find enlightenment in abstruse topics such as quadratic parametric programming. He did achieve one distinction. I was able to get the lowest grade in the class. Greenblatt was saved by Forbes. In his junior year at Wharton, he had chanced upon a short article about Ben Graham's strategy for identifying bargain stocks. That led him to read Security Analysis and the Intelligent Investor, which he describes as the antithesis of what I was learning at school. Graham's perspective on how the market works was so simple and clear, says Greenblatt, that it got me very excited. Above all, Graham taught him one life-changing lesson. As Greenblatt puts it, stocks are ownership shares of businesses, which you're valuing and trying to buy at a discount. The key then, is to identify situations in which there's a particularly large spread between the price and the value of the business. That spread gives you a margin of safety, which Greenblatt, like Graham and Buffett, regards as the single most important concept in investing. Once you realize that your entire mission is to value businesses and pay much less for them than they're worth, it's incredibly liberating. If you see it that simply and can keep that simplicity in your mind, it's very compelling and almost makes a lot of what else you see look silly, says Greenblatt. It kind of gets rid of 99% of everything else that anyone had ever told me about how to look at the world and the market. Many investors get rattled when they read the latest news about, say, a Greek debt crisis that threatens the European economy. But Greenblatt says, the way I look at it is, if I own a chain store in the Midwest, am I all of a sudden going to sell it for half of what it's worth because something bad happened in Greece? I don't think so, but that's what you read in the newspaper, and that's what everyone is looking at. If you have a context to say, well, does it matter or doesn't it matter? It's just very helpful. Indeed, you start to realize that much of the investment world is engaged in fruitless nonsense. Wall Street economists and market strategists pontificate about macroeconomic headwinds and tailwinds that nobody can reliably or consistently predict. Media pundits muse about the significance of short-term price fluctuations that are random and meaningless. Highly intelligent analysts at brokerage firms squander their time calculating next quarter's corporate earnings to the exact penny, an absurd guessing game that's irrelevant to successful, long-term investors. Not to be outdone, academics teach complicated mathematical formulas and speak in a private code about sharp ratios, Sortino ratios, alpha, beta, the Modigliani measure, and other arcane concepts that lend an air of scientific exactitude to the messiness of the markets. Meanwhile, investment consultants harness these highfalutin notions to convince clients that their portfolios need frequent, subtle fine-tuning. Buffett has derided these high-priced peddlers of complexity as hyper-helpers whose advice is often delivered in esoteric gibberish. By contrast, Graham wrote simply and clearly about Mr. He encapsulated the entire game of investing in one brief parable about this muddle-headed character. In The Intelligent Investor, Graham suggests imagining that you own a $1,000 stake in a private business. Every day, your partner, the obliging but irrational Mr. provides you with a valuation of that stake. His price, quote, changes based on how enthusiastic or fearful he feels that day. You may be happy to sell out to him when he quotes you a ridiculously high price, and equally happy to buy from him when his price is low. The rest of the time you can sit on your hands, waiting for Mr. Market to lose his mind once more and offer you another deal that you can't refuse. In other words, the market isn't an efficient machine that reliably and consistently sets fair prices. It's a comedy of errors, a festival of folly. People are crazy and emotional, says Greenblatt. They buy and sell things in an emotional way, not in a logical way. And that's the only reason why we have any opportunity. So if you have a way to value businesses that's disciplined and makes sense, you should be able to take advantage of other people's emotions. This raises an obvious but crucial question. Do you know how to value a business? There's nothing admirable or shameful about your response. But you and I need to answer this question honestly. Since self-delusion is a costly habit in extreme sports such as skydiving and stock picking, it's a very small fraction of people that can value businesses. And if you can't do that, I don't think you should be investing on your own, says Greenblatt. How can you invest intelligently if you can't figure out what something is worth? 7, he adds that most people should just index because they don't understand what they're doing. I don't have the technical skills, patience, or interest to value businesses. So it makes sense for me to outsource the job to professionals who are better equipped for the task. This self-restraint should save me a lot of pain, as Greenblatt observes in the little book that beats the market. Choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot. Every few years I ignore this warning and buy an individual stock. Despite my better judgment, I currently own 3 stocks. One is Berkshire Hathaway, which I expect to hold for many years. I'd like to think that I understand the business well enough to justify this long-term investment, less defensively. I also own a tiny stake in a mining and property company recommended to me by a well-known investor who shall remain nameless. How has it done? So far, it's down 87%. So far, it's down 87%. For now, I'm keeping it as a painful reminder to be more careful around lit matches and dynamite. Stock number 3 is Seritage Growth Properties, a contrarian investment that I cloned from Monish Pabrai when the retail real estate sector crashed in 2020. Depending on the business, Greenblatt uses some combination of 4 standard valuation techniques. Method 1. He performs a discounted cash flow analysis, calculating the net present value of the company's estimated future earnings. Method 2. He assesses the company's relative value, comparing it to the price of similar businesses. Method 3. He estimates the company's acquisition value, figuring out what an informed buyer might pay for it. Method 4. He calculates the company's liquidation value, analyzing what it would be worth if it closed and sold its assets. None of these methods is precise, and each has its limitations. But Greenblatt works on the basis that if a stock is sufficiently cheap, the upside potential significantly outweighs the downside. The underlying concept of buying bargains is simplicity itself, but the execution process isn't that simple because it involves such complexities as roughly predicting a company's future earnings and cash flows. This reminds me of an acerbic comment about investing that Charlie Munger once made at the end of a lunch with Howard Mark. It's not supposed to be easy. Anyone who thinks it's easy is stupid. Greenblatt insists that his own valuation skills are merely average. Rather, his advantage stems chiefly from his ability to contextualize everything he sees in the market, fitting it all into a coherent framework. His faith in this framework is so strong that he issues a guarantee to his Columbia students. If they do a decent job of valuing businesses, buy them at a steep discount to their intrinsic value, and wait patiently for the gap to close between the current price and their appraisal of the value, the market will eventually reward them. 8. The hitch is that you can never tell how long the process of convergence between price and value will take. Still, he says, I'm a firm believer that, in 90% of the cases, the market will recognize a value within 2 or 3 years. This points to a fundamental truth that is one of the most dependable laws of the financial universe. In the short term, the market is irrational and frequently misprices stocks, but in the long term it's surprisingly rational. Eventually, says Greenblatt, Mr. Market gets it right. Unfair bets and ugly ducklings. After leaving Wharton, Greenblatt headed to Stanford Law School, mostly to avoid getting an actual job. He dropped out after a year. Many of his peers followed well-trodden paths to become corporate lawyers or investment bankers. But he didn't fancy toiling for 100 hours a week at a vast, faceless corporation in the pursuit of a conventional career. Ultimately, he wanted to find an enjoyable way to get paid for smart ideas rather than punching a clock. In the meantime, he took a summer job at Bear Stearns, where he fell into a relatively new field, options trading. He recalls, I was executing riskless arbitrage trades by literally running across the trading floor, getting a printout from the one printer, running back to my desk, and scouring the printout to look for anomalies that I could trade. By using put and call options, he could lock in automatic profits with no risk of loss. It opened me up to what was possible on Wall Street. Greenblatt had always been fascinated by gambling. At 15, he'd discovered the furtive joy of sneaking into a dog track and wagering a couple of bucks on a greyhound. His brain was built for betting. I like calculating the odds, he says. Consciously or unconsciously, I'm calculating the odds on every investment. What's the upside? What's the downside? What's the downside? When I mention that all of the best investors seem to think probabilistically, carefully weighing the odds of different outcomes, he replies, I don't think you can be a good investor without thinking in that way. Greenblatt spent the next 3 years as an analyst at a startup investment firm, making risk arbitrage bets on companies involved in mergers. It didn't take him long to realize that this was a game with odious odds. If a merger went ahead as planned, you could make $1 or $2, he says. But if the deal unexpectedly fell apart, you could lose 10 or 20. This was the exact opposite of Graham's strategy of buying dirt cheap stocks, where you can lose $1 or $2 and make 10 or 20. That's a good risk reward. In 1985, Greenblatt launched Gotham Capital with the intention of applying the principles he had learned from Graham. Greenblatt started with $1 billion in 4 years at Drexel Burnham Lambert. So, a little side bet on a promising but unproven 27-year-old wasn't much of a risk. 9. Greenblatt says his investment strategy at Gotham involved making money not from taking risk but from making unfair bets. That's to say, he invested only when the odds seemed to favor him overwhelmingly. The details changed from one investment to the next, but he always sought asymmetric propositions where, I can't lose much and maybe I'll make a lot. He quips, if you don't lose money, most of the other alternatives are good. Unfair bets are rare, but Greenblatt didn't need that many. He typically had 80% of his fund riding on 6 to 8 investments, an extraordinary level of concentration. There aren't that many great opportunities, he explains. I was looking for low hurdles, things that other people would have bought too if they'd done the work. Building on his experience in risk arbitrage, he developed an expertise in special situations that most investors overlooked, including corporate spin-offs, restructurings, and orphan equities that were emerging from bankruptcy. He also invested in small stocks with liquidity constraints, since most institutional investors were too big to buy them. He remarks, it's easier to find bargains off the beaten path or in extraordinary situations that other people aren't looking at. Greenblatt had the latitude to prospect in these offbeat places, because he never let his fund become bloated. We could have raised whatever amount we wanted, but you lower your returns, he says. In 1994, when Gotham's assets reached about $2.5 billion in debt would be dumped into a second company, Host Marriott. A nasty little cast-off that would apparently consist of all the toxic waste that no one wanted to own. The beautiful Swan, Marriott International, would be free to swim off into the sunset, leaving the ugly duckling, Host Marriott, to drown, or so it seemed. Greenblatt knew that almost nobody would bother to analyze Host Marriott, let alone invest in it. It just looked horrible, he says. It had a lot of debt. It was in a bad business. There was nothing good about it. Moreover, it was too tiny for most institutional investors to hold, even if they could tolerate the stench. Existing shareholders of the Marriott Corporation would receive stock in Host Marriott when the spin-off was completed. But Greenblatt was sure they would sell in droves. So what did he do? He zeroed in on the ugly duckling. The way you're going to find bargains, he says, is by searching for hidden value in assets that other people don't want. One clue that Host Marriott might not be as rotten as it looked was that Bollenbach, the guy who designed this evil plan, was going to run it. Why would this canny moneymaker want to take charge of the business if it was truly destined for bankruptcy? It turned out that he was well incentivized to turn the firm around. For good measure, the Marriott family would also own 25% of Host Marriott. So some savvy insiders had a powerful interest in its success. Greenblatt studied the company in depth and discovered a surprising amount of value. Sure, there was plenty of lousy real estate, including some unfinished hotels, but there were also some valuable assets such as airport restaurant concessions and several debt-free properties. Best of all, the stock was fabulously cheap at around $6 per share. But there was also a debt-laden subsidiary that might be valuable too, if its fortunes ever improved. The asymmetry was so amazing, he says. I was buying $6 worth of assets with no debt on it for $4. Plus, I had the upside on the other pile of assets. If the subsidiary was worth nothing, then I just paid $4 for something worth $6. So Greenblatt loaded up, staking almost 40% of his fund's assets on Host Marriott. It was a breathtakingly bold move. It was a struggling business that was leveraged to the hilt. Yet Greenblatt saw what everyone else missed, an irresistibly unfair bet. As Graham had taught him, what mattered most was the margin of safety. If you bought a stock for much less than its intrinsic value, other investors would figure it out sooner or later and drive up the price. In the meantime, says Greenblatt, I didn't see how I was going to lose much money. That's precisely why he made such an aggressive bet. You size your positions based on how much risk you're taking, he says. I don't buy more of the ones I can make the most money on. I buy more of the ones that I can't lose money on. So what happened? In the fall of 1993, Host Marriott began trading as an independent company. Within 4 months, Greenblatt tripled his money as this ugly duckling defied its doubters and took flight. Greenblatt had never expected the wager to work out so quickly. That was luck, he says. But we set ourselves up to get lucky. Now, before I get too carried away, I'll admit that the execution of this investment was not that simple. For a start, Greenblatt bought preferred shares, which would have given him an extra measure of protection if the company had gone bust. He also used call options to structure his bet. What's more, it required a rare combination of cold rationality, independence of mind, and sheer guts to stake so much on a widely reviled business. Still, the underlying principle could not have been simpler. Figure out what something is worth and pay a lot less. Cheap plus holy grail. Greenblatt's investment approach continued to evolve, partly because he saw how Buffett had updated and improved Graham's strategy of buying undervalued stocks. As Greenblatt explains, Buffett added one little simple twist, which made him one of the richest people in the world. Buying cheap is great, and if I can buy good businesses cheap, even better. In his early days, Buffett had made a fortune trading in and out of mediocre companies that he bought at a deep discount. But as his assets ballooned, he needed a more scalable strategy. Under Munger's influence, Buffett shifted to buying what he described as wonderful businesses at fair prices and holding them indefinitely. In 1988, Berkshire invested $248 million, were worth almost $35 million. His mission? To demonstrate that cheap and good companies generate outsized returns. He hired a computer jockey to crunch vast quantities of data, so he could explore how these businesses had performed historically. Greenblatt needed a shorthand measure of cheapness and quality, so he chose two metrics as a rough gauge of these essential traits. First, the company should have a high earnings yield, an indication that it generates lots of earnings relative to its price. Second, it should have a high return on tangible capital, an indication that it's a quality business that effectively converts fixed assets and working capital into earnings. 11. The computer whiz then analyzed 3,500 U.S. stocks, ranking them based on these two metrics. Those with the highest combined score should, in general, be above-average businesses trading at below-average prices. Greenblatt wanted to know what would happen if a hypothetical investor bought 30 of these stocks at the start of a year, sold them after a year, then replaced them with a fresh batch of 30 top-ranked stocks. In his study, he assumed that this process would be repeated every year, creating a systematic way of investing in cheap and good companies. 12. Greenblatt was quite amazed by the results of the backtests. From 1988 to 2004, this strategy would have generated an average return of 38% a year versus 4% a year for the S&P 500. At that rate, $9.6 million versus about $30,000 for the S&P 500. Here is a stock-picking strategy that relied solely on two metrics, and it annihilated the market. It was a startling testament to the power of simplicity. Greenblatt drew on this research to write his miniature gem, the little book that beats the market. In between the jokes, he laid out how to beat the pants off even the best investment professionals by using just two simple tools. If you want to become a stock market master, he explained, stick to buying good companies, ones that have a high return on capital, and to buying those companies only at bargain prices, at prices that give you a high earnings yield. He dubbed this simple combination of two winning traits the magic formula. Do you believe in magic? There is just one problem. Most investors fail miserably to become stock market masters, even when you've done all of the hard thinking for them and presented them with a magic formula. After the little book was published in 2005, Greenblatt began to realize how difficult it was to execute the plan he'd recommended to his readers. He and his kids tried doing it, but found it tricky to keep track of so many trades. He adds, I got literally hundreds of emails from people saying, "Hey, thanks for the book. Can you just do this for me?" He also worried that some readers might harm themselves by using unreliable corporate data pulled from the internet or by messing up the calculations when they tried to apply his formula. What if these errors led them to choose the wrong stocks, and he actually hurt the people he'd set out to help? Greenblatt's solution was to create a free website, which used reliable data and made it easy to screen for stocks that met his two criteria. He often jokes, there ain't no tooth fairy on Wall Street, but he liked the idea of protecting regular investors, so he also set up what he calls a benevolent brokerage firm, which allowed customers to invest solely in his pre-approved list of magic formula stocks. Greenblatt gave his brokerage clients two choices. Option 1. They could open a professionally managed account, which followed a predetermined process of systematically buying and selling stocks from his approved list at fixed intervals. About 90% of the clients chose this do-it-for-me option, which freed them from making any decisions. Option 2. They could take a DIY approach, picking a recommended minimum of 20 stocks from the same list and deciding for themselves when to buy or sell. The plucky few who opted for this DIY route presumably expected that their own judgment would add a little extra magic. Ah, such hubris. When Greenblatt studied thousands of clients' accounts, he was shocked to discover how much worse the DIY investors performed. Over a 2-year period, this group generated a cumulative return of 59.4% versus 62% 7% for the S&P 500. By contrast, the group with professionally managed accounts enjoyed a return of 84.1%, trouncing the S&P 500 index by 21.4 percentage points. Amazingly, the DII investors had squandered almost 25 percentage points of performance by making their own decisions. Their judgment had transformed a market-beating strategy into a market-trailing dud. It was a startling display of self-sabotage. They made all the faux pas that investors do, says Greenblatt. When the market went up, they piled in. When it went down, they piled out. When the strategy was outperforming, they piled in. When the strategy was underperforming, they stopped doing it. In theory, they may have believed in his concept of buying high-quality businesses at low prices. In practice, they chased after stocks when they were more expensive and abandoned them when they were cheaper. To make matters worse, the DII investors also shunned the ugliest stocks on the magic formula list, failing to recognize that these were often the most alluring bargains. Emotionally, it was hard to buy the cheapest companies on the list because their near-term prospects looked bleak and they were frequently tainted by bad news. Fearful of this uncertainty, investors missed out when these beaten-down stocks rebounded and became some of the biggest winners. All of this self-defeating behavior highlights one of the thorniest challenges confronting every investor. It's not enough to find a smart strategy that stacks the odds in your favor over the long haul. You also need the discipline and tenacity to apply that strategy consistently, especially when it's most uncomfortable. It helps immeasurably, says Greenblatt, if you have simple principles that you can just stick to. Simple principles that make sense, that are unshakable. Why is this so critical? Because you need this clarity of thought to withstand all of the psychological pressures, setbacks, and temptations that can destabilize or derail you along the way. It's a hard business, and the market is not always agreeing with you, says Greenblatt. It's the nature of the beast that stock prices are emotional. And you're going to be hit from every which way, and you're going to be reading every expert saying you're wrong. It's particularly hard to keep the faith when you're losing money, or have lagged the market for several years. You start to wonder if your strategy still works or if something has fundamentally changed. But the truth is, no strategy works all of the time. So these periods of financial and psychic suffering are an unavoidable part of the game. Inevitably, weaker players fall by the wayside, creating more opportunity for those with the sturdiest principles and the strongest temperaments. As Greenblatt puts it, one of the beauties of the pain that people have to take in underperformance is that, if it did not exist, everyone would do what we do. Greenblatt has the conviction to hold firm during those painful periods, but it's easy to see why the average investor might waver. In a backtest involving the 1,000 largest companies in the United States, the magic formula generated an average annual return of 19.7% from 1988 to 2009 versus 9.5% annually for the S&P 500. That's a phenomenal margin of victory. Still, the formula trailed the index in 6 of those 22 years, and it produced brutal losses of 25.3% in 2002 and 38.8% in 2008. When you're bleeding that badly, it's hard to remain unflappable unless you share Greenblatt's deep-seated certainty in the inexorable logic of the strategy. These experiences have led him to an important revelation. For most individuals, the best strategy is not the one that's going to get you the highest return. Rather, the ideal is a good strategy that you can stick with even in bad times. In recent years, that realization has inspired Greenblatt to develop a new mousetrap, a long-short strategy that's designed to reduce risk and provide a less painful ride. His goal: to compound money at a reasonable rate with less violent volatility, so that investors in his funds are more likely to make it to the long term. It's a surprising evolution for a famed gunslinger whose concentrated approach returned 40% a year for 2 decades. But it's a reminder that most investors should shoot for solid and sustainable returns, instead of something more heroic. When I owned 6 or 8 names, It was not uncommon to lose 20 or 30% in a few days, every 2 or 3 years. Says Greenblatt, it's a difficult strategy to stick with, so it's not good for most individual investors. But that's perfectly good for me. When something falls 20 or 30%, I don't panic because I know what I own. Nowadays, Greenblatt's team values more than 4,000 businesses and ranks them based on how cheap they are. On the long side, his funds buy hundreds of stocks that trade at a discount to his estimates of fair value. He automatically bets more on the cheapest stock than on the second cheapest. On the short side, he bets against hundreds of stocks that trade at a premium. Again, his position size is determined by valuation, so the most expensive stock is automatically his biggest short position. Our underlying theme is, buy the cheapest, short the most expensive, and I do that in a very systematic way, he says. There's no emotion involved. He knows that some bets will go against him, but he's looking merely to be right on average. It's no easy task to execute a complex strategy involving hundreds of long and short positions. Greenblatt built a 20-person team of financial analysts and tech mavens to help him pull it off. Yet the principles underpinning his strategy are, as ever, so simple and robust that all of us would do well to remember them. 1. Stocks are ownership shares of businesses which must be valued. They should be bought only when they trade for less than they are worth. In the long run, the market is rational and will, more or less, reflect the fair value of these businesses. The problem is that nobody ever knows if this journey toward fair value will take weeks, months, or many years. But Greenblatt is willing to wait because he trusts that these time-tested principles will eventually hold true. If stocks are ownership shares of businesses, and I'm pretty good at valuing them, at least on average, I'll do well over time, he says. The laws of economics and gravity will not be repealed. 4 simple lessons. When I think about everything that I've learned from Greenblatt, I'm struck above all by 4 simple lessons. First, you don't need the optimal strategy. You need a sensible strategy that's good enough to achieve your financial goals. As the Prussian military strategist General Karl von Clausewitz said, the greatest enemy of a good plan is the dream of a perfect plan. Second, your strategy should be so simple and logical that you understand it, believe in it to your core, and can stick with it even in the difficult times when it no longer seems to work. The strategy must also suit your tolerance for pain, volatility, and loss. It helps to write down the strategy, the principles upon which it stands, and why you expect it to work over time. Think of this as a policy statement or financial code of conduct. In times of stress and confusion, you can review this document to restore your equilibrium and regain your sense of direction. Third, you need to ask yourself whether you truly have the skills and temperament to beat the market. Greenblatt possesses an unusual combination of characteristics that give him a significant edge. He has the analytical brilliance to deconstruct a complex game, breaking it down into the most fundamental principles. Value a business, buy it at a discount, then wait. He knows how to value businesses. He isn't influenced by conventional opinion or authority figures such as the Wharton professors who claimed that the market is efficient. On the contrary, he delights in proving them wrong again and again. He's also patient, even-tempered, self-assured, competitive, rational, and disciplined. Fourth, it's important to remember that you can be a rich and successful investor without attempting to beat the market. Over several decades, Jack Bogle watched thousands of active fund managers try and fail to prove their long-term superiority over index funds. All these stars prove to be comets, he told me. They light up the firmament for a moment in time. They burn out, and their ashes float gently down to earth. Believe me, it happens almost all the time. Bogle often argued that the ultimate in simplicity is to buy and hold a single balanced index fund that owns a fixed percentage of us and foreign stocks and bonds. And that's it. No self-destructive attempts to time the market. No fantasies of picking the next hot stock or fund. While writing this chapter, I followed his advice and chose a single index fund for my wife's retirement account, a global fund that invests 80% of its assets in stocks and 20% in bonds. I'm sure this is not the optimal strategy, but it should be good enough, assuming that she holds on to the fund for many years and adds to it regularly. This is a simple strategy based on broad diversification, a reasonable balance between risk and reward, tax efficiency, exceptionally low expenses, and a long time horizon. It lacks boldness and panache, but as Bogle told me, you don't have to be great. Personally, I am perennially torn between the mathematical logic of indexing and the dream of beating the market, but I know this much: whichever path we choose, it pays to keep it simple. Chapter 6. Nick and Zach's Excellent Adventure. A radically unconventional investment partnership reveals that the richest rewards go to those who resist the lure of instant gratification if by giving up a lesser happiness a greater happiness could be found. A wise person would renounce the lesser for the sake of the greater. The Dhammapada, everyone then who hears these words of mine and does them will be like a wise man who built his house on the rock. And the rain fell, and the floods came, and the winds blew and beat on that house, but it did not fall, because it had been founded on the rock. And everyone who hears these words of mine and does not do them will be like a foolish man who built his house on the sand. And the rain fell, and the floods came, and the winds blew and beat against that house, and it fell, and great was the fall of it. Matthew 24:7. 27. Nick Sleep dreamed of becoming a landscape architect. He envisioned himself designing parks and public spaces that offered a refuge from the hurly-burly of life. So, after graduating from Edinburgh University, he took a landscaping apprenticeship at a local firm. My romantic notion of what working there might be was completely shattered by the reality, which was that we were working on dormer windows and car parks, he says. A few months later, he was laid off. The staff went from 30 to 20, and I was one of the 10 that was kicked out. Sleep, who is English, wanted to stay in Edinburgh, since he and his future wife, Sarita, had bought a small apartment in the city suburbs, so I just looked around to see what Edinburgh was good at, he says. A career in information technology seemed like a viable option. But he also learned that Edinburgh had a reputation for fund management. He read an obscure book titled Investment Trusts, explained to help him figure out what the investing business was all about. He came away intrigued. I liked that sense of it being an intellectual investigation. Sleep landed a job as a trainee investment analyst at a small Scottish fund company. He was not abundantly qualified for the job. At college, he had studied geology and then switched to geography, hardly the standard preparation for a stock-picking career. His employment history offered no evidence that he had yearned since birth for a career in finance. He had worked in the Harrods department store, temped at an IT firm, and secured a sponsorship deal for windsurfing. With his movie star looks and soft-spoken charm, he didn't fit the mold of a corporate drone. Still, as luck would have it, he had stumbled into a field that perfectly suited his idiosyncratic mind. Like all of the best investors, Sleep views the world from an unusual angle. He suspects this stems from his formative experience as a teenager at Wellington College, an English boarding school founded by Queen Victoria. Sleep was one of the few students who lived at home, which meant that he floated free on the periphery of school life. He even worked in a pub on weekends, while most of his classmates stayed on their 400-acre campus. I got comfortable with being different from everyone else early on, he says. I was happy being outside the group. When Sleep was about 20, he fell under the spell of Robert Pirsig's Zen and the Art of Motorcycle Maintenance, an inquiry into values. This memoirist tutorial, which had been rejected by 121 publishers, is a strange but brilliant meditation on what it means to lead a life dedicated to quality. Pirsig exalts people who care so intensely about the quality of their actions and decisions that even the most mundane work becomes a spiritual exercise, a reflection of inner traits such as patience, integrity, rationality, and serenity. Whether you're mending a chair, sewing a dress, or sharpening a kitchen knife, he writes that there is an ugly way of doing it and a high-quality, beautiful way of doing it. For Pirsig, motorcycle maintenance provides an ideal metaphor for how to live and work in a transcendent way. The real cycle you're working on is a cycle called yourself, he writes. The machine that appears to be out there and the person that appears to be in here are not two separate things. They grow toward quality or fall away from quality together. As you might imagine, most of the hyper-ambitious strivers on Wall Street don't have a lot of patience for mystical mumbo-jumbo about motorcycles. But Pirsig's vision of a soulful, ethical, intellectually honest approach to life resonated deeply with Sleep and shaped the type of investor he would become. In an email about Pirsig's enduring impact on him, Sleep remarks, "You really want to do everything with quality, as that is where the satisfaction and peace is. But what does this mean when it comes to investing?" In 2001, Sleep and his friend Kai Zakaria created a fund called the Nomad Investment Partnership, which they viewed as a laboratory test for how to invest, think, and behave in the most high-quality way. In one of his eloquent and amusing letters to shareholders, Sleep would muse, "Nomad means far more to us than simply managing a fund. Nomad is a rational, metaphysical, almost spiritual journey, without the sand and camels, although Zach may be happier with them." None of this would matter if it weren't for the stunning outcome of their peculiarly high-minded experiment. Over 13 years, Nomad returned 921, 1% versus 116, 9% for the MSI World Index. In other words, their fund beat its benchmark index by more than 800 percentage points. To put that another way, to 17 million, while 21 million. In 2014, Sleep and Zakaria returned their shareholders' money and retired as fund managers at the ripe old age of 45. Since then, they've managed their own money with equally striking success, approximately tripling their wealth in their first 5 years of retirement. Sleep, with characteristic indifference to conventional opinion, invested almost all of his fortune in just 3 stocks. At times, he and Zakaria have had as much as 70% of their money in a single stock. Among the cognoscenti, few other investors are held in such high esteem. Bill Miller, who says he admires the complete independence and clarity of their thinking, invested his own money in Nomad. Guy Spire, who is friends with Sleep, reveres him as one of the most profound thinkers in the investment world. When I asked Monish Pabrai for advice about which investors to interview, he told me, "Nick, Sleep is exceptional. He does very deep research and has very high concentration. That's a lot of putting your nuts on the line. He would be a fascinating interview, but he won't do it. He's a very private person." Indeed, part of their mystique lies in the fact that Sleep and Zakaria have always flown under the radar. They had minimal interest in marketing their fund and even less interest in self-promotion. As a result, their story has never been told. But over the last few years, I've interviewed Sleep on multiple occasions. Then in the fall of 2018, I spent an afternoon with him and Zakaria at their office on the King's Road in London. A bright and cheery space, which is so informal that Zakaria doesn't even have a desk. He prefers to work in a plush leather armchair, which faces a wall where their matching beekeeper suits hang together from hooks. It was there, in Galactic HQ, that they reflected on what they call their adventures in capitalism. What emerged from our conversations is a heartening morality tale in which the good guys win. It's also a story about the extraordinary advantages that accrue to investors with the discipline and patience to resist the temptations of instant gratification. In a high-speed era dominated by short-term thinking, this capacity to defer rewards is one of the most powerful contributors to success, not only in markets but in business and life. A house built on sand. Zakaria, like Sleep, never dreamed of working on Wall Street. "To be honest, I would have loved to have done something else," he says. I would have been a meteorologist if my parents had let me. I found it fascinating. I used to read weather reports and do my own weather reports, and my parents thought it was stupid. Born in Iraq in 1969, he came from a relatively privileged family. His father worked for the Iraqi Central Bank. His mother lectured on nutrition at the University of Baghdad. But it was a perilous time, rife with political intrigue and violence. We were purged, says Zakaria. His family fled, leaving everything behind. In 1972, a Catholic charity helped his parents find refuge in the UK, where they would raise their 3 children. They pitched up here with nothing, says Zakaria. Literally nothing except an orange Volvo, which they'd been given by someone in Turkey. His father knocked on doors until he found a job as a junior accountant. He worked his way up, then started a successful business exporting machinery to Iraq. Zakaria's parents expected him to join the firm and eventually run it, helping to expand their cushion against the uncertainties of life. Money is very important to them, he says. The accumulation of money, not necessarily spending it. It's about security and status. In 1987, Zakaria headed to Cambridge University to study mathematics. Everything seemed on track, but that same year, his father went bankrupt. It turned out that he'd speculated in the stock market using borrowed money. He had traded hot stocks touted in dubious tip sheets and had fallen for pyramid schemes pitched by sleazy salesmen. One stockbroker would recommend a stock based on this pyramid of who was in first and who was in last, says Zakaria. The more money you put in, the higher you got in the pyramid. My father never got high enough, and when it all collapsed, he lost everything. The family was deluged with debt, and the export business died. For Zakaria, it was a sickening introduction to the investment business. My father had made his money on things he understood and lost it on things he didn't understand, and he was taken to the cleaners by very unscrupulous people. These memories left Zakaria with a permanent suspicion of salespeople, get-rich-quick schemes, and the casino aspect of Wall Street. After graduating from Cambridge in 1990, Zakaria entered the investing game, largely by default. The family business was no longer an option. Unlike his siblings, he couldn't become a doctor because he faints at the sight of blood. And meteorology is stupid, so he took a job in Hong Kong as an equity analyst at Jardine Fleming, one of Asia's leading asset managers. It went well enough until 1996. Then his boss, a hotshot fund manager, was accused of allocating successful trades to his own account, allegedly depriving clients of profits that should have been allocated to their accounts. The fund manager was fired and fined millions of dollars. But with the firm's reputation in tatters, the business had to be restructured. Zakaria was laid off. I rang around a couple of friends and said, "Do you have anything?" "I'll literally do anything." A friend who ran a stockbroking desk at Deutsche Bank took mercy and gave him a job as a sell-side analyst specializing in Asian stocks. It was one of life's cruel cosmic jokes. Zakaria, with his distrust for salespeople in general and stockbrokers in particular, would earn his keep by hawking stock tips to the bank's institutional clients. "I did it for 4 years, and it was absolute hell," he says. Not being someone who is easily sold to, I couldn't sell to anyone. His time at Deutsche provided Zakaria with a crash course in the ways of Wall Street. "It was a shocking place to work," he says. "Moral compromises went with the territory. My good friend and boss there said, 'You must never persuade someone not to do what they want to do. Even if you think it's wrong, just let them do it because you'll never be thanked.' And I thought, that's a terrible way to live. It's awful. I mean, if you think they're making a mistake, you should tell them." Zakaria says he was so ill-suited to the job that he'd have been fired within a month if his boss hadn't shielded him. Still, there was one consolation. He met Nick Sleep. After 3 years in his first investing job back in Edinburgh, Sleep had become an investment analyst at Sun Life of Canada, a financial services giant with tens of thousands of employees. "I was almost allergic to working there," he says. "Once you've worked for a feisty company, it's quite difficult to go work for something big, dull, and boring." He quit after a few months and landed in 1995 at Marathon Asset Management, where he would stay for more than a decade. It was a scrappy, high-flying investment firm in London that was trying to outbox the big guys. Sleep's mentor. There was one of Marathon's co-founders, Jeremy Hosking, an English eccentric whose hobbies include collecting vintage steam engines. He's naturally iconoclastic, says Sleep. His bias is to buy just about the most despised thing he can find. He likes the controversy, the difficulty. When the Asian financial crisis struck in 1997, Hosking and Sleep went scavenging for cheap stocks in the smoldering markets of Southeast Asia. Everyone else seemed to be running for cover as Asia's economic miracle turned to disaster. But the Marathon men found an unlikely ally in an Asia-based broker who wasn't like everyone else, Zakaria. Sleep and Zakaria talked regularly about the crazy bargains they were unearthing in places like Singapore, Hong Kong, and the Philippines. Most brokers focused on popular assets that were easy to sell. But Zakaria was excited by reviled stocks trading at fabulous discounts. Zach was a rubbish stockbroker because what would appeal to him would appeal to us and would appeal to nobody else, says Sleep. So it had no commercial value. You couldn't sell it to anybody else. But Zakaria's eye for discarded jewels was precisely what made him valuable to Marathon. Hosking told him, when you can't sell a stock to anyone else, call us. During the miracle years, investors had been so bullish about Asia that they had bet on stocks trading at 3 times the replacement cost of their assets. During the crisis, you could buy those same stocks for 1/4 of the replacement cost of their assets. In less than a year, Marathon invested about $150 million order. There was just one problem. This exceeded the total assets in his fund. Still, nobody seemed to care, since it was all a game. The fund manager was betting that the bank would grant him a fraction of the shares he requested, and that the stock would surge. Lo and behold, Gigamedia's stock shot up from 88 on the day of the IPO, giving this money-losing minnow a valuation of more than $100,000 a year. At one extreme, says Sleep, you've got Buffett being as principled as you can possibly be. At the other extreme, there are marketing-driven companies that happen to be selling investment funds, but could be selling cars or washing machines. They couldn't give a toss about their clients. When Sleep's bosses gave him the green light to start the Nomad Investment Partnership in 2001, he asked Zakaria to join him as co-manager of the fund. It was obvious that we were always going to do something a little bit odd, says Sleep. Indeed, from the start, they regarded Nomad as an act of rebellion against what he calls the sin and folly of the investment industry. We wanted to prove that there's another way of investing and another way of behaving, says Sleep. You don't have to go and do all of the Wall Street bollocks. Never mind the bollocks 3. Sleep and Zakaria had no interest in building a colossal fund that would shower them with fees. They didn't fantasize about appearing as market gurus on CNBC, or being fetishized on the cover of Forbes. They had no desire to buy themselves castles, airplanes, or yachts. Their ambition was simple. They wanted to generate superb long-term returns. Specifically, their target was a 10-fold increase in Nomad's net asset value. Sleep, who has 3 daughters and a godson, framed this mission in somewhat whimsical terms, if they ever asked him. What did you do during the war? He wanted to reply. We turned £1 into £10. Anyone looking to achieve stellar returns would do well to study what Sleep and Zakaria figured out about where to focus their attention. And, equally important, what they ignore. Sleep cites a line from the philosopher William James. The art of being wise is the art of knowing what to overlook. He and Zakaria rejected a slew of standard practices. We were just getting rid of all the things we didn't like, says Sleep. We were signed-up members of the awkward squad. For a start, they disregarded all of the ephemeral information that distracts investors from what matters. Sleep notes that information, like food, has a sell-by date. But some of it is especially perishable, while some has a long shelf life. This concept of shelf life became a valuable filter. For example, when I spoke with Sleep and Zakaria again in May 2020, the financial news was full of speculation about the near-term impact of the COVID-19 virus on consumer spending, corporate profits, unemployment, interest rates, and asset prices. An article in the Financial Times even debated whether a U.S. economic recovery might resemble the letter V, U, R, N, W, L, or a Nike swoosh. To Sleep and Zakaria, this fleeting news coverage was all part of the daily soap opera of the market, too superficial, short-lived, and unreliable to hold their attention. They couldn't predict how the economic news would unfold, so why waste mental energy on the unknowable? Similarly, they ignored the flood of short-term financial data and recommendations gushing out of Wall Street. Brokerage firms, which have an incentive to spur activity among investors, crank out unreliable estimates of the next quarter's earnings per share for thousands of companies. Sleep refers dismissively to the quarterly EPS junkies who crave this information, which will already be worthless in 12 weeks. As he sees it, the short-term crowd responds constantly to false stimuli, whether it's the latest economic data point or the trivial news that a company has beaten analysts' expectations. You need to be wired not to believe the bullshit, to not be listening. One practical way of extricating themselves from this muck was to discard all of the sell-side research excreted by Wall Street. We put it in a pile, says Zakaria. Every month or so you start looking through, thinking, I'm bored. So the whole lot would go in the bin. It really was all just gossip and bits of nonsense, and we became very happy with the idea of not hearing it. Likewise, Sleep and Zakaria told stockbrokers that it was pointless phoning them with sales pitches since they relied on their own research to reach independent conclusions. They also disengaged from the day-to-day action of the market by minimizing their use of a Bloomberg terminal. Fund managers often stare interminably at a wall of 4 monitors flashing real-time data and financial news at them. The Bloomberg, which cost about $100 million, a paltry sum by industry standards. They reopened only when they could find sufficiently alluring opportunities to deploy additional cash. They also took delight in turning away investors who seemed unsuitable or irritating, regardless of how rich they were. Zakaria chuckles at the memory of a comically awful meeting with a team that managed billions for heirs to the food packaging company Tetra Pak. These financial advisors demanded access to Nomad's proprietary stock research as a condition for investing their clients' money in the fund. Zakaria says the atmosphere grew, frostier and frostier, with Sleep crossing his arms and legs in a sign of mounting annoyance. After 15 minutes, Sleep and Zakaria showed their visitors the door. Potential investors were also required to sign a document acknowledging that Nomad was inappropriate for anyone with less than a 5-year time horizon. I wanted it in a different psychic space than all the other investments they had, says Sleep. We weren't just another bloody hedge fund, we were tackling the whole investment problem in a different way. Indeed. Nomad rejected all of the get-rich-quick tactics that hedge funds routinely use to pump up their short-term performance. High-testosterone strategies that Sleep dubbed investment Viagras. For example, Nomad never used leverage, never shorted a stock, never speculated with options or futures, never made a macroeconomic bet, never traded hyperactively in response to the latest news, never dabbled in exotic financial instruments with macho names such as Lions and Prides. Instead, Sleep and Zakaria played what they viewed as a long, simple game, which involved buying a few intensively researched stocks and holding them for years. Their slow, patient, deliberate strategy was so countercultural that it sounds almost quaint. Investor timeframes have shortened drastically over the years. When Vanguard's founder, Jack Bogle, entered the investment business in 1951, mutual funds held stocks for an average of about 6 years. By 2000, that figure had shrunk to about 1 year, provoking Bogle to warn that the folly of short-term speculation has replaced the wisdom of long-term investing. In 2006, Sleep wrote to shareholders that Nomad's average holding period for stocks was 7 years, whereas other investors held the U.S. stocks in Nomad's portfolio, excluding Berkshire Hathaway, for an average of only 51 days. Sleep and Zakaria were appalled by this cultural shift toward short-termism. "We cannot for the life of us figure out why society at large is served by having company owners swap seats every few months," wrote Sleep. "This basic building block of society is broken when those with their hands on the permanent capital change their minds without their underwear. Nomad would succeed by taking the opposite approach. The Bible would say that you want to build your house on rock rather than sand," says Sleep. "You want to build something that has permanence, a house built on rock." Sleep and Zakaria named their fund Nomad because they were willing to roam anywhere in search of value. They were not trying to replicate a particular index or perform well on a relative basis. They were gunning for outstanding absolute returns, unconstrained by reference to what anyone else was doing. Their quest took them to some of the least popular corners of the globe. The fund began trading on September 10, 2001, one day before the attack on the Twin Towers. Markets cratered as investors confronted unfathomable threats of terrorism, war, and economic disruption. Adding to the gloom, many investors were still in shock from the bursting of the tech bubble. Sleep and Zakaria invested boldly amid the turmoil, targeting temporarily depressed businesses that others were too scared to own, since the future seemed so precarious. In the Philippines, they invested in Union Cement, the nation's largest cement producer. After its stock had plunged from 30 cents to less than 2 cents, pessimism was so pervasive that the market valued the business at 1/4 of the replacement cost of its assets. In Thailand, they invested in Matacon, a newspaper publisher whose stock had crashed from 1, it traded at 0.75 times revenues, and was worth about 3 times what they paid for it. In the United States, they bought preferred shares of Lucent Technologies, a fallen telecom star that had lost 98% of its value. These were classic cigar butts, not the best businesses, but fantastically cheap. By the end of 2023, Nomad's net asset value had doubled as opportunistic bets like these paid off. The supply of bargains dwindled as fears receded and markets revived. So, Sleep and Zakaria ventured to one of the few remaining pockets of despair. In 2004, they crossed the border from South Africa into Zimbabwe. Under Robert Mugabe's despotic rule, Zimbabwe's economy was paralyzed by corruption, a currency collapse, the nationalization of many privately owned farms, and mobs of looters. Undaunted, Sleep and Zakaria bought a basket of 4 Zimbabwean stocks, virtual monopolies that traded as if they were almost worthless. Zimsim, a cement producer, sold on the stock exchange in Harare for 1/70th of the replacement cost of its assets. Writing to Nomad's investors about the perverse appeal of this detested market, Sleep remarked, "The clients will hate it. Compliance will hate it. The consultants will hate it. Marketing will hate it. The size of the investment opportunity is tiny. It is not part of the benchmark. It's perfect." For a while, Nomad valued its basket of bargains at 0 because trading on Zimbabwe's stock exchange ceased entirely. The economy remained a catastrophe. Still, by the time Nomad sold the last of its Zimbabwean stocks in 2013, they'd risen between 3-fold and 8-fold. As a souvenir, Sleep and Zakaria gave each Nomad shareholder a worthless banknote for 100 trillion Zimbabwean dollars, which the government had issued at the height of hyperinflation. Nomad's appetite for reasonable businesses selling at unreasonably low prices made sense, given the opportunities available at the time, but this strategy had one drawback. When stocks like these rebounded and were no longer that cheap, they had to sell them and hunt for new bargains. But what if nothing particularly attractive was on sale when they sought to redeploy those winnings? An obvious solution to this reinvestment risk was to buy and hold higher quality businesses that were more likely to continue compounding for many years. This second strategy grew out of a costly mistake. In 2002, Nomad made its biggest wager to date, investing in Stagecoach, a debt-ridden British bus operator that had overreached disastrously while expanding overseas. The stock had crashed from £2.85 to 14p, but Sleep and Zakaria figured it could easily be worth 60p. In part, they were betting on a turnaround led by the founder, a former bus conductor who'd run the firm so adroitly in the past that he'd become one of Britain's richest people. He came out of semi-retirement to streamline the business and refocus on its neglected cash cow, the UK bus operation. His strategy worked. Sleep and Zakaria cashed out around 90p and congratulated themselves on a six-fold gain. But Stagecoach was a better business than they'd realized. In late 2007, the stock hit £3. "We felt like a bit of a horse's arse," says Sleep. "We had framed it in our own minds as only ever being a cigar butt." Sleep and Zakaria started searching for other businesses run by far-sighted managers whom they could trust to keep building wealth over time. "If they're thinking rationally and thinking about the long term," says Sleep, "you can subcontract the capital allocation decisions to them. You don't have to be buying and selling shares." They also began to wonder what characteristics account for the success of companies with unusually long shelf life. And they would reach the revelatory conclusion that one business model may be more powerful than all the rest. Their term for it is scale economies shared. The company that introduced them to this model was Costco Wholesale, an American discount retailer that embodied everything they sought in a business. When they first invested in Costco in 2002, its stock had tumbled from 30 amid concerns about the company's low profit margins. But Sleep and Zakaria saw underappreciated strength in Costco's fanatical focus on delivering value to shoppers. At the time, its customers paid a 5 for every 30 to about 850 in 1,908 to less than 20,000 a year by removing the light bulbs from vending machines in its offices. Bezos was obsessed with saving money and time for customers, and he invested patiently for the future, seeding new business initiatives that he didn't expect to bear fruit for 5 to 7 years. Each year, he invested hundreds of millions of dollars in the form of discounted prices and shipping subsidies, a consummate display of deferred gratification. True to form, Wall Street grumbled about Amazon's lack of reported profits, failing to appreciate that Bezos was patiently laying the groundwork for mind-blowing growth. Writing to Amazon's shareholders in 2005, Bezos explained that, relentlessly returning efficiency improvements and scale economies to customers in the form of lower prices, virtuous cycle that leads over the long term to a much larger dollar amount of free cash flow, and thereby to a much more valuable Amazon. Sleep and Zakaria had found their corporate soulmate. That year, Bezos launched Amazon Prime, a membership service that offered free 2-day shipping for an annual fee of $30 per share. In 2006, Sleep and Zakaria resigned from Marathon and made Nomad a fully independent fund, giving themselves even more latitude to follow their idiosyncratic convictions. They bet 20% of the fund's assets on Amazon and secured permission from their shareholders to go beyond that limit. A quarter of their clients yanked their money from Nomad, fearful of its overexposure to one stock. Skepticism about Amazon continued to swirl. In the midst of the 2008 market meltdown, Sleep attended an event in New York where George Soros spoke about the threat of an impending financial apocalypse. Soros, one of the most successful traders in history, named just one stock that he was shorting as the world fell apart: Amazon. Over lunch that day, Sleep caught up with Bill Miller, whose mutual funds owned the largest outside stake in Amazon. Miller had recognized Amazon's strengths earlier than anyone else and had bought 15% of the company. But he told Sleep that he'd been forced to reduce his holdings to meet redemption requests from investors fleeing from his funds. Sleep phoned Zakaria in London that evening and asked, "Are you sure we know what we're doing? Because everyone here is going in another direction." They had never felt more confident about a company's eventual greatness. But what if they'd misanalyzed the business? What if they'd missed something and all the doubters were right? Either we're brilliant, thought Sleep, or we're really toast. Amazon lost almost half of its market value in 2008, while Nomad fell 3%. Sleep and Zakaria held an emergency meeting in an appropriately posh location to discuss the possibility that Nomad's future might be in peril if the market continued to crash. They shuddered at the thought of ending up as analysts at some shitty Wall Street firm. Still, they didn't crack. While others panicked, they exploited the market mayhem to upgrade their portfolio, concentrating even more heavily on the highest quality companies, including Amazon, Costco, ASOS, and Berkshire Hathaway. When the rebound came, the rewards were breathtaking. From 2009 through 2013, Nomad returned 404%. In early 2014, Sleep and Zakaria dissolved the Nomad investment partnership. By then, it had grown to about $3,000 per share in 2020, giving it a market value of $3 trillion or $1,500 a share. How did it feel? I hated it, he says. I felt horribly conflicted, and I'm not sure it's a good decision. For a while, Sleep sat patiently on tens of millions of dollars in cash, not sure how to invest his windfall from selling those shares in Amazon. But when we spoke in 2020, he had invested the money in a fourth stock, ASOS, an online retailer that he'd previously owned at Nomad. Since he repurchased it, the stock had already doubled. In short, life is still sweet. 5 lessons with a long shelf life. As I see it, there are 5 key lessons to be learned from Sleep and Zakaria. First, they provide a compelling example of what it means to pursue quality as a guiding principle in business, investing, and life. A moral and intellectual commitment inspired by Zen and the art of motorcycle maintenance. It's easy to dismiss quality as a vague and subjective notion, but it offers a surprisingly useful filter for many decisions. For example, it was obvious to Sleep and Zakaria that a low annual management fee that merely covered Nomad's operating costs was a higher quality option than a fatter fee that would enrich them regardless of how they performed. Second, there is the idea of focusing on whatever has the longest shelf life, while always downplaying the ephemeral. This principle applied not only to the information they weighed most heavily, but also to the long-lasting companies they favored. Third, there is the realization that one particular business model, scale economies shared, creates a virtuous cycle that can generate sustainable wealth over long periods. Sleep and Zakaria took this one great insight and profited massively from it by focusing on a few high-quality businesses that followed a similar path. Paradoxically, they also argued that it was less risky for them to own a small number of stocks, usually about 10, than to own hundreds, a standard strategy that would inevitably have produced less dazzling returns. We knew that we didn't know many things, says Sleep. So it made sense to us only to have a few shares, because those were the only things we ever understood and ever really knew. It was no surprise to them that the businesses they knew the best and loved the most, Amazon, Costco, and Berkshire, proved remarkably resilient, even when the world was turned upside down by COVID-19. After all, their economies of scale enabled them to provide customers with exceptional value for money. With Amazon and Costco, in particular, what you've seen is their businesses being enhanced by the crisis, says Zakaria. The worse the environment gets for the economy in general, the better it gets for these cost-advantaged businesses. Fourth, it's not necessary to behave unethically or unscrupulously to achieve spectacular success. Even in a voraciously capitalistic business where self-serving behavior is the norm. During the financial crisis, Sleep wrote about the destruction caused by a culture in which the players just have to win, and are not too squeamish about the means. He and Zakaria wanted Nomad to embody a more enlightened form of capitalism. This explains why they adopted a fee scheme that favored their shareholders over themselves. They were generous to each other too. For example, Zakaria insisted that Sleep should own 51% of their investment firm, instead of an equal share. If a disagreement were ever to arise, Zakaria trusted Sleep to make the final decision. Sleep says it was unthinkable to abuse a partner who had loaded a revolver, passed it across the table, and said, "Go on then, you can shoot me if you like." He adds, "There's a kindness to the relationship, which I think is important to our success." It's telling that they still share an office several years after winding up their fund. As Sleep puts it, good behavior has a longer shelf life. A strong emphasis on charity is also a distinguishing feature of their gentle version of capitalism. Once we had proved what we wanted to do running Nomad, it was very obvious to both of us that the job at hand was to give the money back to society, says Sleep. It lowers the risk of us being bent out of shape by having too much money. Plus, you have the joy of giving it away. Zakaria and his wife, Maureen, support an array of charities that are oriented towards scientific research and medicine, including the London Mathematical Laboratory, the Royal Society, and the Royal Hospital for Neurodisability. Meanwhile, Sleep spends much of his time helping on-site youth zones, a charity that creates safe havens where kids in poor areas can socialize and learn new skills. He says the primary focus for him and Zakaria has shifted to doing the maximum amount of good over the very long term. That said, Sleep hasn't renounced all worldly pleasures. He loves motor racing and competes regularly in his 1965 Shelby Mustang GT 350 and his 1967 Lola T70. He also took part with his daughter Jess in a 36-day rally from Beijing to Paris, via Mongolia and Siberia, taking turns driving his 1964 Mercedes Pagoda. Fifth, in a world that's increasingly geared toward short-termism and instant gratification, a tremendous advantage can be gained by those who move consistently in the opposite direction. This applies not only to business and investing, but to our relationships, health, careers, and everything else that matters. Deferring gratification is no easy task, given the environment in which we live. In wealthier nations, everything is available on demand. Limitless food, information, bingeable TV shows, every flavor of porn, or whatever else tickles our fleeting fancy. Our attention spans are shortening under a high-speed bombardment of emails, text messages, Facebook posts, and Twitter notifications. Similarly, in the investment realm, we can now dart in and out of the market instantaneously by pushing a few keys on our mobile phones. We're all struggling in our own ways to adjust to this technological and social revolution, which is both miraculous and perilous. As pleasure-seeking creatures, we tend to be drawn to whatever feels good now, despite the price that we, or others, may have to pay later. This is evident not just in our individual lives, but collectively in everything from government deficits to unconstrained energy consumption. It's all about deferred gratification, says Sleep. When you look at all of the mistakes you make in life, private and professional, it's almost always because you reached for some short-term fix or some short-term high. And that's the overwhelming habit of people in the stock market. Just think for a moment of the many unchecked impulses that ruin investors' returns. For example, the tendency to trade too frequently, to make emotional decisions based on alarming or alarmist news stories, to join the herd in charging after the most popular and overpriced assets, to dump funds that have lagged for a year or two, or to sell winning stocks prematurely instead of leaving them to compound for years. The ability to resist such urges is one of those big superpowers, says Sleep. You need to give it huge weight when you're weighing what works. Sleep and Zakaria are titans of impulse control. How else could they have held Costco for 18 years and Amazon for 16 years, while it has soared from $3,000 per share? They understood the fundamental truth that we benefit by deferring gratification and prioritizing long-term outcomes. But it's not enough to grasp this principle intellectually. Equally important, they constructed an internally consistent ecosystem that supported such behavior. For a start, most of their investors were non-profits, such as college endowments, with expansive time horizons. In his shareholder letters, Sleep praised them effusively for their gentle patience, a tactful way of reinforcing the right mindset. Nomad also invested in businesses run by fellow nonconformists, such as Bezos and Buffett, who took an exceptionally long view. It helped too that Sleep and Zachariah set themselves up in a peaceful office above a Chinese herbal medicine store on the King's Road, far removed from the frenetic action in major investment hubs. They also eliminated disruptive influences by shunning sell-side analysts and financial consultants, who compulsively monitor the day-to-day performance of funds. They were so detached from all of the drama and excitement that they likened themselves to hermits or monks. If you and I hope to achieve long-lasting success as investors, we need to follow their example by systematically resisting the external and internal forces that push us to act impetuously. With that in mind, I ignore all of the useless media chatter about looming market corrections and crashes. I go weeks on end without checking how my investments have performed. My default position is to do nothing. Hence, the majority of my portfolio sits quietly in 2 index funds and a value-oriented hedge fund, all of which I've owned for at least 20 years. My costliest mistakes have come whenever I grew impatient or envious of other people's returns and strayed off course by gambling on private companies or individual stocks that held the promise of a racier route to riches. The paradox here is that the slower road almost always proves to be faster in the end. The investors I admire most tend to be heroically inactive, not because they're lazy, but because they recognize the benefits of patience. Howard Marks once told me, "Our performance doesn't come from what we buy or sell. It comes from what we hold." So the main activity is holding, not buying and selling. I've always wondered if it wouldn't enhance an organization to say, "We only trade on Thursdays, and the other 4 days of the week, all you can do is sit and think." Nobody personifies this slow-motion mindset better than Thomas Russo, who has generated market-beating returns over more than 3 decades at Gardner Russo and Gardner, which is based in Lancaster, Pennsylvania. "I call myself a farmer," says Russo. "Wall Street is flooded with hunters, people who try to go out and find the big game. They fell it and bring it back, and there's a huge feast and everything is fabulous, and then they look for the next big game. I plant seeds, and then I spend all of my time cultivating them." His biggest holdings include Berkshire Hathaway, Brown-Forman, and Nestlé, all of which he's owned since the 1980s. A few years ago, when he was 59, I asked Russo if he expected to own Berkshire and Nestlé for the rest of his life. He replied, without hesitation, "I would think so." Like Sleep and Zachariah, Russo has built his entire career on an appreciation of the power of deferred rewards. All of the businesses he owns share one trait, which he describes as the capacity to suffer. That's to say, they invest for the very long haul, even when this expense requires them to stomach years of painful upfront losses. As Russo remarks, we tend to benefit whenever we sacrifice something today to gain something tomorrow. What's fascinating to me is that this timeless principle applies not only to business and investing, but to every area of our lives. We can see it when we exercise or diet, when we study hard for an exam or stay late at work, and when we save money or invest for retirement. In each case, we profit in the long run by embracing or enduring something that seems unappealing in the short run. Conversely, says Sleep, I think it's almost always true that the things we do that make us unhappy look appealing in the short term. He cites an array of popular pitfalls: getting drunk, eating too much cake, telling lies, visiting girly bars, and nicking sweets from a corner shop. In the moment, he says, all of these things seem like a good idea. They're exciting. They reward. There's a bit of a rush. But in the end, they borrow from the long term. None of this is new. In the book of Genesis, Esau, a sucker for instant gratification, trades his precious birthright to his brother Jacob in return for a worthless bowl of lentil soup. By contrast, Jacob's son, Joseph, a master of deferred gratification, has the foresight to set aside vast quantities of grain during the 7 years of abundance, ensuring that Egypt survives the 7 years of famine that follow. Thousands of years later, we're presented over and over with this same choice between the present and the future, the instant and the deferred. For most of us mortals, it's a challenging choice. But Zacharias says he enjoyed the slightly pious feeling of donning a hair shirt and rejecting instant gratification, while others succumb to temptation. This reminds me of a marvelous Buddhist phrase that's used to describe one of the subtle rewards of resisting unhealthy or unskillful behavior: the joy of non-remorse. Likewise, Kabbalists such as Rav Yehuda Ashlag and Rav Philip Berg teach that the only way to achieve enduring happiness, fulfillment, and freedom is to resist our negative inclinations. In his landmark book Kabbalah for the Layman's, Rav Berg writes, instead of choosing the line of least resistance, the quick fix, instant gratification, the Kabbalist chooses the line of most resistance. It's a profoundly important truth about the counterintuitive path to contentment. One practical trick, says Sleep, is to reward yourself in the short term by relishing the prospect of all the wonderful benefits you will enjoy because you chose to override your desire for instant gratification. That way, deferral becomes associated with pleasure and you're much more likely to embrace it. Indeed, says Sleep, I quite like the overriding, because you just know that it's going to make your life better. Chapter 7: High Performance Habits. The best investors build an overwhelming competitive advantage. By adopting habits whose benefits compound over time, it makes no small difference then whether we form habits of one kind or of another from our very youth. It makes a very great difference, or rather all the difference. Aristotle, I think that people underestimate until they get older. They underestimate just how important habits are and how difficult they are to change when you're 45 or 50, and how important it is that you form the right ones when you're young. Warren Buffett in 1990, Tom Gaynor weighed 190 pounds. Nobody would have mistaken him for an Olympic gold medalist in beach volleyball. Still, he says, his weight was within the realm of reasonableness. That year, at age 28, he took a job running the investment portfolio at the Markel Corporation, an insurance firm based in Richmond, Virginia. Investing is a sedentary sport that largely entails reading, thinking, and playing with numbers. Gaynor was built exquisitely for it. Even as a boy of 8 or 9, his idea of an enjoyable Friday evening was to sit in front of the TV with his grandmother and watch Wall $21 billion in stocks and bonds, plus a collection of 19 fully owned companies, not to mention around 17,000 employees. If you're an executive or a money manager who has these kinds of responsibilities, you're playing the game 24 hours a day, 7 days a week. There's no off-season. There are no days off, he says. As a consequence, I think it's very important to be disciplined about paying attention to your wellness, your sleep, your exercise, a little work-life balance, spending time with your wife and kids and your fellow parishioners. All these sorts of things. Such behavior may not create the outcome that you want, but it improves your odds. What's distinctive is the indomitable consistency of his discipline. Most people get fired up for a few days, then flame out. I own a kettlebell and a skipping rope, neither of which I've used more than 3 times. The primary purpose of their existence is to make me feel guilty. Yet, Gaynor keeps plugging away, never perfect, but always directionally correct. The key, he says, is that he is radically moderate about everything he does. If I make extreme changes, they're not sustainable. But moderate, incremental changes, they're sustainable. He's also careful not to let himself slide too far in the wrong direction. After a brisk walk around a lake near his office, he shows me how his Apple Watch monitors his movements to ensure that he meets his 30-minute daily exercise requirement. Likewise, he checks his weight every day unless he's traveling, and if it got away from me. Then I'll work out a little harder, or will try to be a little more conscious of what I eat for a while. If you never let it get out of whack, it's easier to keep things centered. And that, in general, describes much of how I try to get through life. This radically moderate and doggedly persistent strategy demonstrably works. When I spent a day and a half interviewing him in 2017, Gaynor weighed in at 194 pounds, which is not much more than he weighed 27 years earlier. In terms of weight gain, I have outperformed him by a hefty margin, illustrating how minor differences in day-to-day behavior compound over decades. All of this points to an important conclusion that applies both to investing and life. Resounding victories tend to be the result of small, incremental advances and improvements sustained over long stretches of time. If you want the secret to great success, it's just to make each day a little bit better than the day before, says Gaynor. There are different ways you can go about doing that, but that's the story. Just making progress over and over again is the critical part. The aggregation of marginal gains. Gaynor has applied the same philosophy to investing. Many investors lurch erratically from one short-term bet or promising strategy to the next. Much like yo-yo dieters who bounce between fad diets without entrenching a sustainable solution, Gaynor, the patron saint of steady progress, adheres to a stock-picking strategy built on 4 principles that haven't changed in 30 years. They point him in the right direction and help him to avoid being stupid. They're like guardrails. First, he seeks profitable businesses with good returns on capital and not too much leverage. Second, the management team must have equal measures of talent and integrity. Third, the company should have ample opportunity to reinvest its profits at handsome rates of return. Fourth, the stock must be available to him at a reasonable price. Once Gaynor finds a business that passes his 4-part test, he looks to invest with a forever time horizon, leaving the stock to compound indefinitely while deferring the tax consequences of selling. Berkshire Hathaway was the first stock he bought at Markle back in 1990, and his stake has snowballed to more than 15 to 140 billion as the CEO of Double Line Capital. Gundlach, a brash and brilliant billionaire known as the King of Bonds, says he's wrong about 30% of the time. So he asks one critical question before making any investment. If I assume that I'm wrong on this, what's the consequence going to be? He then tries to structure his bet so the outcome won't be ruinous, whatever happens. Make your mistakes non-fatal, Gundlach tells me. It's so fundamental to longevity. And ultimately, that's what success is in this business. Longevity. Gaynor's portfolio is built to last. It would have been much more lucrative if he'd loaded up on Amazon, Google, and Facebook. But his investment decisions, much like his approach to food and exercise, are not intended to be optimal. Rather, he's attempting to be consistently and sustainably sensible. The cumulative effect of operating this way over 3 decades has been extraordinary because he has harnessed the power of long-term compounding without ever galloping at such a pace that he would heighten the odds of some catastrophic fall-off. In the 2 worst years of his investment career, Gaynor's stock portfolio fell 10.3% in 1999, when tech stocks went berserk, and he made the mistake of shorting them, and 34% in 2008. When the credit crisis revealed that some of the businesses he owned were more leveraged than he'd realized. His wife, Susan, who is the CEO of a manufactured housing business owned by Markle, says those 2 periods were dark nights of the soul for Gaynor, filled with self-doubt and despair. Gaynor says the financial crisis was so stressful that he lost much of his hair. Still, he survived and eventually resumed his steady upward trajectory. The results are remarkable. From 1990 through 2019, Gaynor's stock portfolio achieved an average annualized return of 12.5% versus 11.4% for the S&P 500. At that rate, 2 million versus 40 million. The Markle family, which founded the firm in 1930, hired Gaynor who had followed the company for years as an analyst and stockbroker to help them replicate Berkshire Hathaway's business model. Gaynor took premiums from Markel's insurance operation and used that float to buy stocks, and since 2005, whole companies, much as Buffett invested premiums from his insurance operations. It was a masterful display of cloning sustained characteristically over decades. Still, Gaynor dislikes the term cloning, as it might imply that he merely copied Buffett, instead of observing what worked and recombining it to suit his own circumstances. How did it turn out? Gaynor pulls out a copy of Markel's 1987 annual report and shows me that its total assets back then were $37.4 billion. Markel's market value has grown to about $8.33 per share. By the end of 2019, its stock had climbed to $11.43. That's a 137-fold gain. What Gaynor's record shows is that you don't need to be extreme to achieve exceptional long-term results. On the contrary, he says, people get themselves into trouble with extremes. His steadfast pursuit of a radically moderate path would have met with the approval of some of the wisest thinkers in history, such as Confucius, Aristotle, Buddha, and Maimonides. Aristotle, the ancient Greek philosopher, argued some 2,400 years ago that excellence and lasting happiness depend on our ability to seek out the golden mean, an intermediate position that is equidistant from each of the extremes. When it comes to physical pleasures such as food, wine, and sex, he taught that we should stake out a middle ground between overindulgence and abstinence. Similarly, in the face of risk, he recommended steering a judicious course between the opposing extremes of timidity and recklessness. For the man who flies from and fears everything and does not stand his ground against anything becomes a coward. And the man who fears nothing at all but goes to meet every danger becomes rash. For Gaynor is neither cowardly nor rash. Everything he does seems reasonable and balanced, from the way he eats and exercises to the way he structures his portfolio, as a compromise between diversification and concentration. The beauty of his moderate approach to investing in life is not just that it delivers bounteous rewards, but that it's replicable by regular human beings like you and me. Some of the famous investors I've interviewed have so much brain power that they seem to operate in another realm, including Charlie Munger, Ed Thorpe, and Bill Miller. Gaynor is highly intelligent, but his real advantage is behavioral, not intellectual. Comparing himself to some of his cleverest peers, he remarks, "I compensate for the lack of intellect with more discipline and steadiness and persistence." That said, it's easy to underestimate Gaynor. Jovial and self-deprecating, he lacks the ego and glamour we often expect from the lords of high finance. He drives a Toyota Prius. "I like getting 50 miles per gallon because I'm cheap," he says. "And if we did not need oil, I think the world would be a more peaceful place." He lives in a pleasant but modest townhouse. It's just low maintenance. And he describes himself as very happily married to his high school sweetheart, a Presbyterian minister's daughter whom he dated when he was 15 and married at 19. For their first date, his parents drove them to a custard stand in the small town of Salem, New Jersey, where he grew up on a 100-acre farm. In short, there's nothing flashy or grandiose about Gaynor, yet it would be hard to find a better role model in the investment world. After all, his satisfying, slow, and steady method of building wealth relies heavily on common sense and well-chosen habits, not esoteric skills or daredevil risks. When I ask him what regular investors should do to get rich, he offers the least exotic advice imaginable. Live on less than you make, invest the difference at a positive rate of return. You cannot fail if you accomplish those two tasks. He adds, if you're living on less than your means, you're rich right now. Gaynor is remorselessly careful about controlling costs. He manages Markel's investments with razor-thin expenses and maximum tax efficiency, a cost advantage that any of us can emulate by trading infrequently and avoiding financial products with onerous fees. He's equally frugal in his personal life, a habit that he says was hardwired in him during his Quaker childhood. He can't bear to buy food in airports and can barely bring himself to pay for 2 restaurant meals a day while on vacation, even though he earns millions of dollars a year in total compensation. If frugality is an essential ingredient of his formula for financial success, so too is diligence. As an undergraduate at the University of Virginia, he could get away with coasting. Not so much. He typically arrives at the office by 7:15 a.m., packs his mornings with work since that's when he's most productive, and allows few distractions. "We've structured things to be quiet," he says. "We're sitting here in my office. How many times have you heard my phone ring?" Attached to the front of his computer screen is a piece of paper bearing a quotation from Michael Jordan. "I failed over and over again in my life, and that is why I succeed." Gaynor likes to remind himself that Jordan didn't make it onto his varsity basketball team as a sophomore at high school, but then harnessed his superhuman work ethic and sheer willpower to become one of the greatest players of all time. "You cannot control the outcome," says Gaynor. "You can only control the effort and the dedication and the giving of 100% of yourself to the task at hand. And then, whatever happens, happens." When I interviewed him again in 2020, the United States was in the throes of riots and a pandemic, but Gaynor remained as focused as ever on controlling his own effort, sticking to his investment process, and setting an example for his employees. "Keep putting one foot in front of the other," he told me. "That's what has guided me my whole life. So why should that be different now?" Another feature of Gaynor's incremental self-improvement strategy is his deep commitment to continuous learning. He reads voraciously. Everything from scientific books on habit formation to biographies to novels by his favorite author, Mark Twain. But he also views himself as a node in a neural network, interconnected with many smart people who can assist in his constant quest to expand his knowledge and improve his skills. Chuck Aker, a renowned money manager whom we'll soon meet again, helped him to refine his understanding of reinvestment as the most powerful driver of business success. Josh Tarasoff, a gifted hedge fund manager, helped him to figure out why he should own Amazon. Gaynor also served for years alongside Buffett on the board of the Washington Post Company. One indelible lesson was that persistence and endurance are essential components of Buffett's edge. The energy and stamina that he has is absolutely unbelievable. In the morning, he's ready to go, and he's the Energizer Bunny who just keeps going and going and going. That's an athletic feat. It's no accident that Gaynor enjoys the trust of many leading investors. "One of the advantages I have is that I'm a nice guy," he says. "I try to help people. I try to do the right thing. As a consequence, what I've found is that I have this wonderful network of friends, colleagues, and associates who are rooting for me rather than against me. And they help you. They just help you." We sometimes assume that you have to be ruthless to elbow your way to the top. But Gaynor illustrates the subtler benefits of consistently looking to be kind and decent. I've come to think of this underappreciated edge as the Mensch effect. Guy Spire, who runs the Aquamarine Fund, invests so much of his energy in helping others that he is similarly surrounded by people who wish to help him. Spire describes this phenomenon as the compounding of goodwill. If your goal is sustainable success, Gaynor is convinced that it works better to behave admirably. Not least because more people want to do business with you if you're trustworthy. Sometimes people build great careers and enjoy great successes for a period of time through bluster and bullying and intimidation, slipperiness, he says. But that always comes unraveled. Sometimes it takes a while, but it does. The people you find that just keep being successful year after year after year. I think you find those are people of deep integrity. When I try to identify the many reasons why Gaynor has achieved so much, I'm reminded of a concept that Nick Sleep mentioned to me. The aggregation of marginal gains. The phrase was coined by a legendary performance coach, Sir David Brailsford, who turned the British cycling team into an unstoppable force at the Beijing and London Olympics. Those triumphs stemmed not from one major innovation, but a multitude of minor improvements, which combined to create a crushing advantage. For example, Brailsford cyclists raced on wheels rubbed with alcohol to enhance their grip. They wore electrically heated overshorts to maintain the right temperature for their muscles. They studied how surgeons wash their hands to reduce the risk of illness. They even brought their own pillows on trips so they were more likely to sleep well. Brailsford, who has an MBA, was inspired by the Japanese principle of Kaizen, continuous improvement, which had played a starring role in vaulting Toyota to greatness. Speaking with Eben Harrell at the Harvard Business Review, Brailsford explained, "It struck me that we should think small, not big, and adopt a philosophy of continuous improvement through the aggregation of marginal gains. Forget about perfection, focus on progression, and compound the improvements." Sleep, who is an avid cyclist, says the best businesses share this obsession with securing even the most marginal gains. He recalls how Lord Harris, the founder of Carpetrite, insisted on reusing old price tags, riding on both sides to save a penny here, a penny there. "It's not one secret sauce," says Sleep. "You just have to care about all the little things and add them all together." If you want to understand Gaynor's success, then look no further. Nobody cares more about all the little things. Individually, his day-to-day habits seem inconsequential, the equivalent of cyclists traveling with their favorite pillows. He gets up early and arrives at the office early. He jogs and does yoga. He eats heaps of salad and a dearth of donuts. He works in a quiet office where he can focus. He consistently applies 4 time-tested principles as a filter for every investment idea. He invests in a tax-efficient manner. He keeps his investment expenses as low as possible. He lives way below his means. He reads insatiably. He studies and intelligently clones other sophisticated investors. He prays, goes to church, and draws emotional strength from his faith in a higher power. He behaves in ways that inspire trust and goodwill. None of these practices is earth-shattering in isolation. But remember, it's the aggregation of marginal gains that's so powerful. Moreover, the modest benefits generated by smart habits continue to compound over many years. In the short run, all those tiny, incremental advances seem insignificant. But time is the enemy of bad habits and the friend of good habits. When you pound away year after year, decade after decade, the cumulative effect is stunning. Indeed, what sets Gaynor apart is one indispensable trait. He is the king of constancy. The good news, then, is that we don't need a secret sauce or a stratospheric IQ. What we need is a selection of sensible habits that are directionally correct and sustainable. Habits that give us a marginal advantage that will compound over time. Gaynor has set us on the right track. Now let's see what other high-performance habits the best investors adopt to give themselves that persistent edge. Bring the heat. In 2000, I interviewed Jeff Vinnick, a secretive investment superstar who, at 33, had become the manager of the world's biggest and most famous mutual fund, Fidelity's Magellan Fund. Will Danoff, who succeeded him as the manager of Fidelity's Contra Fund, says Vinnick was the best fund manager of their generation at Fidelity, an investing prodigy. Vinnick beat the S&P 500 during his 4 years at Magellan, left Fidelity on a sour note after an ill-timed bet on bonds, then launched a gunslinging hedge fund whose results were a wonder to behold. When we spoke, his company, Vinnick Asset Management, was about to return billions to his investors, so he could manage his own riches and spend more time with his family. By then, he'd spent a total of 12 years as a fund manager and had averaged a stunning 32% a year. When I asked Vinnick why he'd been so successful, he offered 2 explanations. First, he said, "I've really used the same consistent approach to investing throughout my career, which is focusing on individual companies with good earnings, outlooks that are selling at very reasonable valuations. For example, he recently made a fortune on Little. Mundane restaurant stocks that will grow earnings 20% a year, but are selling at 12 times earnings. That's the real show, and that's the way to make money, in retrospect. This seems to me a perfect example of Joel Greenblatt's notion of reducing the complexity of investing to its essence and applying the most fundamental principles over and over again. Second, said Vinnick, there's another constant through the 12 years, and that's very, very hard work. The more companies you can analyze, the more cash flow statements you can go through every line of. The more good ideas you're going to find, and the better the performance is going to be. There's no substitute for hard work. What was his schedule like? I'm usually in the office at 6:45 in the morning, Vinnick told me. I go home at approximately 5 o'clock p. So I can spend a lot of time with my family. Usually after my children go to bed, I'll do 2 to 3 hours of reading at night. He waded through heaps of corporate filings and industry publications and tried to read all the research that Wall Street puts out. It helped that he had a phenomenal memory. The way I operate is just to keep track in my head of what's going on in literally thousands of companies. That way, he was poised to detect subtle shifts that others would overlook. For example, the turning point when profits began to accelerate at a scorned cyclical business whose prospects were about to improve. Danoff's investment style is different, with more emphasis on holding stocks for the long run, but his work ethic is no less intense. Money management is all about turning over more rocks, talking to more analysts, looking at more annual reports. And the more you do, the better you're going to do, he says. It's crazy competitive. Danoff has managed the contrafund since 1990. Still, through some peculiar quirk in his wiring, his hunger for beating the market and adding value for his shareholders has never dwindled. Other fund managers don't give a shit, quite frankly, he says. Many are in it for the fees or the glory. I care more. Danoff reads me a letter he received in 1993 from a couple who had invested in his fund to save for their 1-year-old son's college education. We have enclosed his picture so you can get a sense that there are real people out here trusting you with their hard-earned money. For Danoff, that responsibility, combined with guilt, fear, and the desire to set a good example, is a powerful motivator, he declares. I have to bring the heat every day. Whatever their motivation, I think of the best investors as mental athletes. They strive constantly for an intellectual advantage. More information, better information, faster information, or simply a more nuanced interpretation of information that's already out there for everyone to see. All that hard-earned knowledge compounds over time and pays off in unpredictable ways. Danoff, who meets with the management of hundreds of companies each year, shows me his notes from an April 2004 meeting with a dying dot-com business, Ask Jeeves. Its executives revealed that they were getting crushed by an unbeatable upstart, Google. That was the day, says Danoff, when I first realized that Google is a special company. Primed with that insight, he met with Google's co-founder Sergey Brin and CEO Eric Schmidt in August 2004 and began to grasp the enormity of its potential. Google's revenues were doubling every few months, says Danoff, and it boasted 25% operating margins, loads of cash, and no debt. Its financial performance was extraordinary, particularly when compared with the many unprofitable unicorns of today. Most fund managers steered clear when Google went public later that month, but Danoff's fund became one of its largest investors. 16 years later, the company, now renamed Alphabet, is still one of his biggest and most profitable investments. As a marquee player at a firm with $7.3 trillion in customer assets, Danoff can gain access to almost anyone. But what distinguishes him is his determination to leverage that advantage by driving himself incessantly to keep turning over those rocks. On a research trip to Palo Alto in 2010, it bothered him to discover a gap in his packed schedule. Wednesday after 4:30 p. Why aren't we seeing anybody? He asked his colleagues. Maybe we should see Tesla. Danoff visited the money-losing carmaker as an afterthought, arriving late on a December afternoon when it was turning dark outside. Within minutes, Tesla's charismatic founder, Elon Musk, made an unscheduled appearance and described his vision of, making fabulous cars that America is going to be proud of again. Danoff was so impressed that he made an early and extremely lucrative investment, which he continues to own a decade after that auspicious trip. It's no coincidence that Vinnick and Danoff both started out as protégés of Peter Lynch, who had run the Magellan Fund for 13 years with blazing intensity. When I interviewed Lynch 2 decades ago, he explained the simple logic that had driven him to study so many stocks each day. I always thought that if you looked at 10 ideas in a day, you might find one good one, he told me. If you looked at 20, you might find 2. Recalling one of his best investments, Lynch added, "If 100 people had visited Chrysler in 1982 with an open mind, 99 would have bought it." Once again, it's all about the cumulative effect of many minuscule advantages, which add up miraculously over years. The one extra company that Lynch bothered to visit. The one empty time slot that Danoff insisted on filling. The 2 or 3 extra hours of reading that Vinnick pushed himself to complete after his kids went to bed. The best predictor of success is often nothing more mysterious than the unflagging fervency of a person's desire. Early in his career, Bill Miller asked Lynch for advice. Lynch told him that the investment business is so rewarding financially and intellectually that it attracts an overabundance of intelligent people. The only way you can beat them is to outwork them, said Lynch, because nobody is just so much smarter than the next person. Lynch told Miller that he stayed ahead of the pack by reading investment research while he carpooled to the office at half past 6 a.m., working after dinner and on weekends and taking no vacations for years. When Miller asked if it was possible to slow down as you got older, Lynch replied, "No. In this business, there are only 2 gears, overdrive and stop." Miller agrees. That's basically right. You have to be focused. In 2014, when Marty Whitman was 90, I asked him why he'd performed so badly during and after the 2008 crash. A rare failure for one of the giants of value investing. As I got older and richer, I got lazier, he told me. I really knew better in 27 and didn't act on it. I should have sold all my housing-related stocks. It doesn't reflect on the investment techniques. You've got to be diligent and careful, and in 2008, I wasn't. I admired Whitman's candor, but his confession troubled me. I'd invested with him for many years and been happy with the results, which led me to trust his firm with a major portion of my mother's savings. It hadn't occurred to me that he would become complacent. Looking back on his dismal handling of the financial crisis, Whitman remarked, "It's intellectually dissatisfying, but it doesn't make that much difference. What's the difference if my kids end up with $10 million less and charities end up with $10 million or $20 million less?" I didn't have the heart to tell him that his lack of care and diligence would make a profound difference to my mother. Very few people could be married to me. To surpass so many smart competitors, it's not enough merely to outwork them. You also have to outthink them. Even the most experienced investors must engage in a ceaseless process of continuing education because the world changes so drastically that aspects of their knowledge become outdated. As Munger often remarks, one of Buffett's most valuable traits is that, even in old age, he remains a continuous learning machine. On a typical day, Buffett might read for 5 or 6 hours, frequently isolating himself in his office with the door shut. Buffett is a perfect example of the degree to which you can improve yourself over the years, says Paul Lountzis, the president of Lountzis Asset Management. Lountzis, who has attended Berkshire's annual meeting for 3 decades, is awed by Buffett's ability to keep evolving. He started out by investing in cheap stocks, then embraced better businesses, then bought whole companies, then ventured into foreign markets such as China and Israel, then invested in 2 industries he'd famously avoided, railroads and technology. That evolution enabled Buffett to make the most lucrative stock pick of his career in his late 80s, an investment in Apple Inc. that has so far earned a profit of more than 30. When Lountzis was 8, he started earning money by washing dishes. He later worked as a cleaner at McDonald's and paid his way through Albright College by working full-time in a hospital every weekend and vacation. It took him 8 years to graduate. On the side, he studied investing. I immersed myself fanatically, he says. At 13, he read about Buffett. At 14, he was mesmerized by Ben Graham's The Intelligent Investor. He then became captivated by Philip Fisher's 1958 classic Common Stocks and Uncommon Profits, which introduced him to the practice of scuttlebutt, research as a means of gaining an informational advantage. Those two books really created the foundation, says Lountzis. I've read them both 50 or 60 times. Lountzis is a warm and exuberant man who speaks effusively of his 4 adult children and his wife, Kelly, who has stayed by his side for almost 40 years. But his life is built almost entirely around his compulsive craving for any knowledge that could make him a better investor. I try to read 4, 5, 6, 7 hours a day, 7 days a week, he says. I have no hobbies. I've never golfed in my life. It's just my personality, always trying to get smarter, to learn. He regards social functions as a bothersome distraction. I love people. But if I'm not learning, growing, and being stimulated intellectually, I'd rather be elsewhere. Part of what he cherishes about his wife is that she places no demands on me, and I can't tell you how important that is. She understands me and lets me be me. Very few people could be married to me. Lountzis makes no apologies for his extremism. You need a maniacal focus to really be great at anything. Anyone who tells you that you can have everything all at once, you can't. I mean, you don't become Roger Federer by not playing tennis. It has to be consuming. Lountzis is a ravenous consumer of insights from the titans of business and investing. He adores books about entrepreneurs such as Nike's co-founder, Phil Knight. I could read everything ever written about him. That fascinates me. That fascinates me. He also has a server on which he's stockpiled thousands of videos featuring financial wizards who help him to think better about investing, markets, and where the world is headed. Hedge fund managers such as Monish Pabrai and Stanley Druckenmiller, venture capitalists such as Michael Moritz and Jim Gutz, and private equity visionaries such as Leon Black and Steven Schwartzman. Lountzis says he has at least 500 videos of Buffett, along with any recording he can find of Munger's infrequent public appearances. And then there are his transcripts of dozens of their annual meetings. Buffett and Munger are not just really smart, he says, they're geniuses. Most days, Lountzis watches a video on his iPhone while riding a Peloton bike at his gym. Most nights, he lies in bed and watches a video on his iPad, often lulled to sleep by the sweet sounds of investment wisdom. As he listens, he keeps pondering the same underlying questions. What am I missing? Who's doing something that no one else is doing? How can I get better? His aim is never to replicate other investors' behavior. You can't mimic them because you're not them, he says. Learn it and adapt it, and modify it into your own process. There is breadth to his studies. But what makes Lountzis such a powerful learning machine is his habit of obsessive repetition. For example, he estimates that he's watched Buffett's 1998 lecture at the University of Florida 15 times and has read the transcript at least 5 times. Likewise, he studied Berkshire's 1993 annual report with such devotion that he can recite, in order, the 5 main factors that Buffett said he considers when evaluating the riskiness of any stock. It's this same habit of repetition that has kept Lountzis trekking to Omaha for Berkshire's annual meeting for nearly 30 years, and has led him to read the same books dozens of times. The benefit of so much repetition, he says, is that many foundational teachings are etched in my brain, not unlike the effect of repeating the same prayers or affirmations every day. I suspect that the value of repetition is vastly underrated, and that most of us would do well to find 1 or 2 books that we read so often that they become part of us. I dip into the Zohar almost every day, and there are other books that I return to again and again, including Meditations by Marcus Aurelius, The Wisdom of Truth by Rav Yehuda Ashlag, and The Book of Joy by the Dalai Lama and Archbishop Desmond Tutu. having ingrained many timeless investment principles so they are part of his essence. Launces follows his own bespoke process to assemble a portfolio of around 15 intensively researched stocks. 6. He focuses on outstanding businesses with leaders who are creative, adaptable, visionary, and have enormous courage. Such qualities are more important than ever in an era of unprecedented disruption, which threatens even the most dominant businesses. The problem, says Launces, is that qualitative factors such as adaptability or courage are not measurable in financial statements, which offer a quantitative record of the past. His solution is to operate more like an investigative reporter than an accountant. Businesses are changing very rapidly, and many of them are becoming obsolete. So you have to see around corners and get some insight beyond the numbers, says Launces. You've got to go out in the field and talk to competitors, customers, former employees, and then create a mosaic that you can dovetail on top of the numbers. With that in mind, he frequently conducts in-person interviews with experts, such as retired CEOs, who can provide unique, differential insights. Laura Geritz is an equally formidable learning machine, but she has built a different type of informational advantage. While Launces invests primarily in the United States, Geritz is one of America's foremost investors in foreign markets. In a typical year, she spends 6 to 9 months roaming around the world in search of the best investments. At the age of 48, she's already traveled to 75 countries. Geritz, who is the CEO and Chief Investment Officer of Ronder Global Advisors in Salt Lake City, Utah, feels a profound sense of duty to shareholders in her 2 mutual funds. But she's not that interested in piling up money for herself, she remarks. I have enough. Above all, she's an intellectual adventurer, propelled by the passion to learn. In an industry overrun by alpha males, many molded by the same elite business schools, Geritz fits none of the stereotypes of her profession. She's a true original who likens her nonlinear investment approach to the unconstrained poetic rhythms of free verse. From the start, she was never a conventional candidate for a career in fund management. Many of her relatives were farmers and factory workers. Her father took a position as a literature professor at a small college and moved the family to what Geritz describes as a tiny little town in western Kansas, straight out of the opening paragraph of In Cold Blood. In case you don't remember the opening paragraph of Truman Capote's non-fiction novel about a quadruple murder. It begins like this. The village of Holcomb stands on the high wheat plains of western Kansas, a lonesome area that other Kansans call out there. Geritz, a diminutive Midwesterner with a mild and unassuming manner, may not seem like a warrior, but making the journey from out there to where she is today required astonishing drive and determination. Geritz studied political science and history at the University of Kansas, but she also delighted in reading the Wall Street Journal every day. By 19, she'd saved enough to invest for the first time, buying shares in a fund run by Marty Whitman. She fantasized about investing professionally, but figured that she could never break into the business unless she developed a skill that set her apart. So she did a master's degree in East Asian languages and culture, lived in Japan for a year, and became fluent in Japanese. As a result, she landed a job as a bilingual client representative at American Century Investments. A couple of years later, she won a spot as an analyst on the firm's fund management team, a position that could attract as many as 12,000 applicants. She subsequently spent a decade at Wasatch Advisors, earning renown as a market-beating fund manager who specialized in emerging and frontier markets. She quit to create her own firm in 2016 and hired 3 analysts who work alongside her in one very noisy room. When we first spoke in 2017, Geritz's funds were only 2 weeks old, but she'd already made research trips to Russia, Turkey, Japan, South Korea. Twice a year, she screens about 69,000 stocks, which helps her to identify unloved markets that she can visit in her global scavenger hunt for great companies at good prices or good companies at great prices. I like to go where others aren't going, she says. If you're daring to be different, to be great, You have to go against the grain. The market that excited her most was Turkey, where she just met with about 30 companies. But it wasn't hard to see why so few investors shared her excitement. Turkey's autocratic president, who had celebrated his own magnificence by building himself a palace with more than 1,100 rooms, had recently survived an attempted military coup. He lashed back by declaring a state of emergency, jailing thousands of soldiers, police, and judges, closing media outlets, and denouncing his political opponents as terrorists. The nation's reputation was further scarred by a series of suicide bombings, including one at Istanbul's main airport. Tourism collapsed, the currency plunged, inflation and debt soared, foreign investors fled. But Gerritz had visited Turkey many times before, allowing her a more nuanced perspective. A few years earlier, when optimism about the country's economic future had been in full bloom, she'd attended an investment conference in Istanbul. Back then, the hotel hosting the event had wanted $1,200 a night for a room, and she'd refused to stay there. This time I paid $70 a night for a hotel, says Gerritz. To me, that's pessimism to an extreme. The day-to-day reality also seemed nowhere near as frightening as the foreign news coverage suggested. On the ground, I don't feel any reason to be afraid. It's one of the friendliest countries in the world. For Gerritz, that gap between reality and perception offered an ideal opportunity to invest for the long haul in three of Turkey's best businesses: its largest grocery chain, its leading defense company, and its dominant maker of candy. All three had sustainable competitive advantages: reliable cash flows, high returns on invested capital, and, most critical, strong balance sheets. Plus, they were so cheap that she was unlikely to suffer any permanent loss of capital. Given the dangers in developing markets, this unwavering emphasis on risk mitigation is crucial. Indeed, most of the companies Gerritz owns have net cash, enabling them to endure terrible times when the supply of capital dries up and weak businesses wither. I'm really investing in survivors, she says. I buy great companies, but I like to buy them in countries that have been hit. Gerritz's willingness to travel extensively gives her a cumulative advantage over more parochial investors. The more you go out into the world, the more you see the patterns, she says, including cycles of boom and bust that recur in different countries as credit expands or contracts and optimism rises or falls. This pattern recognition helps in avoiding the massive blow-ups you can get in emerging and frontier markets. For example, she sold out of Brazil during a period of euphoria when foreign capital had flooded in. The government had overspent, and prices had gone crazy. The symptoms of excess looked ominously familiar. The hotels were $1,000 a night, easily, she recalls. I had spent, I think, $35 on a piece of pizza in the airport. She saw similar warning signs in Nigeria when foreigners piled in, convinced that it was the best investment destination in Africa. Her wary verdict: I've seen that movie before. I've seen it in China when valuations go high, and everyone loves the market. I've seen it in Brazil. Before each trip, Gerritz creates a study program designed to enrich her understanding of the place she's visiting. I try to read at least 3 books for every country I go to, she says. Typically, one book is about the economics or politics of the country or region, and one is a lighter piece of pop culture, such as a mystery or crime novel. If we're going for a research trip to Uganda, I probably carry a tiny suitcase full of clothes and a giant backpack full of 20 books, she says. It's a big joke. She also carries a Kindle, but I've had it go down in a couple of countries, and I can't live without books. Gerritz and her team at Ronger meet every couple of weeks to discuss a book that they've been reading as a group. The last book we read was Investing the Templeton Way, which I've read many times, but it might also be something like Grit or The Creative Brain. For the past 13 years, she has also chosen one major subject, sometimes 2, that she studies in depth throughout the year. These topics, which she selects with joyous anticipation, have included Africa, the Middle East, physics, oil, and the literature and history of Russia. In 2019, we chatted over a sushi lunch, and I asked Garrett about her latest topic. Her reply, "Oh, it's a quirky one. I'm reading all about explorers, starting from the Vikings." Garrett, who reads 2 or 3 books a week, seldom bothers with newspapers and ignores the minute-by-minute news on her Bloomberg terminal. "I'd rather read The Rise of the Robots and think about what the world might look like 10 years from now than think about what the world looked like 10 minutes ago." It's an unusually cerebral approach to investing, based on her belief that reading deeply and traveling widely will give her a more expansive perspective that is a significant, yet intangible, edge. There is a limit to just sitting in an office and perusing financials day in and day out, she says. "I don't think our job is a linear one." Garrett has even tried to institutionalize her freewheeling mindset by designating Fridays as our creative day, which her colleagues can spend as they wish. She often uses it to sit beside a stream in Salt Lake City, where she reads in peace or writes in journals as a way of synthesizing ideas from her travels. She finds it useful to be based in Utah. Being here, off the beaten path, allows you to think. During the coronavirus pandemic, an earthquake and several construction projects made her apartment unsuitable for deep thinking, so she rented a quiet house with a stream in a remote part of Idaho and quarantined herself contentedly with 45 books. But Jarrett's also wanders farther afield to other places that are conducive to contemplation. Among them, she visits an island off the Australian coast, with only 8 houses. You take a boat with your groceries and they leave you on the island. Sometimes you have cell phone communication and sometimes you don't. You don't have internet. You have some music, and you have a beautiful view of the water, and you have your books. Intermittently, Garrett plants herself in a foreign location for weeks at a time, so she can immerse herself more fully in the culture, studying how the locals live, spend, and consume. She rents a cheap vacation property near the center of the market she wants to learn about, and uses it as her regional base, partly because the wear and tear of flying back and forth gets really hard, since she travels in economy class. Over the years, she has stationed herself in countries as diverse as Tanzania, Kenya, England, France, Holland, Dubai, Abu Dhabi, Thailand, Singapore, and Japan. Several years ago, when Japanese property prices were depressed, she grabbed the chance to buy an apartment in the heart of Kyoto, the ancient imperial capital, which gives her a base from which to visit companies across Asia. It's a simple place with a bed, a sofa, a table, and a couple of chairs. It used to be a restaurant specializing in blowfish, a deadly delicacy unless the poison is skillfully extracted. Her yard is dominated by a big rock that she can't move because the locals believe it was placed there to honor the snake god. Jarrett spends at least 1 month a year in Kyoto. When I ask if she regards America or Japan as her home, she replies, honestly, Japan. Most of us yearn to live in a place where we feel a sense of belonging and inclusion, but her natural state is to be a complete and total outsider. For investors, she says, one of the critical components is just to be able to observe, and that's all you can really do in Japan. Be an observer, because you'll never get embedded enough in society to be fully accepted as part of it. To invest successfully in a country as distinctive as Japan, she must set aside her preconceptions and observe the culture on its own terms. For example, American companies typically put their shareholders' interests first. But Jarrett's, whose Ronder Overseas Fund has 1/3 of its assets in Japan, says the priority for Japanese companies is to serve their customers, followed by their employees, business partners, and society at large. And then I think the shareholder comes last. Activist investors from the West often try in vain to persuade Japanese CEOs to boost profits in the short term by deploying cash more productively or taking on more debt. But Jarrett says the Japanese care more about building companies that survive, sometimes for centuries, despite such threats as earthquakes, tsunamis, wars, and epidemics. It's not an instant gratification culture, she says. Given her inclination to build wealth sustainably, their conservatism suits her. Gerritz's globe-trotting career has satisfied her limitless curiosity. But it comes at a cost. You can't stop, she says. If I'm pausing for any length of time, I lose my edge. You owe it to your investors not to pause because it's their future. Even simple pastimes that most normal people enjoy, like going to the ski slopes or hanging out with friends, would be very hard for me, she says, because all I want to think about is stocks and countries. What about family? I don't have kids. And I'm really fortunate because I have a husband who I love, and who knows that this is what I do, and knows what it takes. So he has always been incredibly supportive. Her husband, Rob, an American whom she met in high school, is in international sales at a manufacturer of sporting goods. His work has given him the flexibility to tag along on many of her research trips, but their jobs require them to spend long periods apart. He mostly lives in their home in Kyoto, while she mostly lives in their home in Utah. Gerritz knew from the start that a high-pressure investment career would demand extreme focus, so she postponed any thought of raising children. Part of it was the challenges and rigors of being a female in the business early on, recognizing that in order to keep up with the guys in the industry, that might not be the best thing to do. In those days, there were hardly any female role models at American Century. But Gerritz remembers one woman in her office who couldn't work beyond 8 o'clock A to 5 o'clock P because she had a child. She was told that they would never promote her to a higher level because the minimum hours they expected were a lot longer. You didn't have to be told. You just emulated who was successful, and the people who were successful were those who stayed in the office from 6 A to 10 P and then were there Saturday and Sunday. Later in her career, Gerritz felt ready to have a child, but by then, her husband was more hesitant. Then the time got away from us. Does she ever regret it? Sometimes, yes. On the other hand, she says, I love what I do so much that I don't feel like I've sacrificed. The art subtraction. If there is one habit that all of the investors in this chapter have in common, it's this. They focus almost exclusively on what they're best at and what matters most to them. Their success derives from this fierce insistence on concentrating deeply in a relatively narrow area while disregarding countless distractions that could interfere with their pursuit of excellence. Jason Zweig, an old friend who is a personal finance columnist at the Wall Street Journal and the editor of a revised edition of The Intelligent Investor, once wrote to me, think of Munger and Miller and Buffett, guys who just won't spend a minute of time or an iota of mental energy doing or thinking about anything that doesn't make them better. Their skill is self-honesty. They don't lie to themselves about what they are and aren't good at. Being honest with yourself like that has to be part of the secret. It's so hard and so painful to do, but so important. I think this applies to any elusive skill that we hope to master, whether it's picking stocks, healing patients, or wrestling with words. One of my heroes is the late Oliver Sacks, an eminent neurologist and a superb author, who put up a big yellow sign in his house with the word "No" written on it in block letters. In a memoir, he explained that it was his way of reminding myself to say no to invitations so I could preserve writing time. Thousands of years earlier, the Daoist philosopher Lao Tzu wrote that the path to wisdom involves subtracting all unnecessary activities. To attain knowledge, add things every day. To attain wisdom, subtract things every day. The art of subtraction is incalculably important, particularly in an age of information overload, when our minds can so easily become scattered. If you expose yourself to it, there's a deafening din of discordant political news, social media notifications, robocalls, and other disruptive noise. In World Without Mind, the existential threat of big tech, Franklin forewarns we're being dinged, notified, and clickbaited, which interrupts any sort of possibility for contemplation. To me, The destruction of contemplation is the existential threat to our humanity. It's also an existential threat to investment success. Hence, Gerritz regularly disappears to sit beside a waterfall on a mountainside in Kyoto where she can read, write, and muse. The late Bill Ruane, who generated fabulous returns at the Sequoia Fund, once spoke to me from what he called my hideaway, a hotel suite in New York City where he worked alone, disconnected from colleagues in his nearby office. Guy Spire, who has attention deficit hyperactivity disorder, moved his family from Manhattan to a rented house in a quiet neighborhood of Zurich, where it's easier for his beautiful but distractible mind to resemble a calm pond. Spire's office, which is a short tram ride from his home, has a library in which he doesn't permit himself a phone or a computer. He has consciously designed his physical environment to support contemplation. As the head of an investment team with more than 260 since 2002, by constructing an unhurried life in a tranquil place, Aker can shelter himself from the influence of other investors' brilliant ideas and stay focused completely on the things that work for us. In essence, he's discovered one well-stocked pond, and he's content to fish there for the rest of his days. Or, as Aker puts it, we can't dance with all the ladies. All of this leads to a few practical conclusions that can help us to become wealthier and happier. First, to be successful and fulfilled, we need to decide what we care about most and be honest with ourselves about what we do best. Second, we need to adopt daily habits that enable us to improve continuously where it truly counts, and to subtract habits that divert us. It's worth writing down a list of beneficial habits that should be part of our daily routine, but it's equally valuable to compile a do-not-do list, reminding us of all the ingenious ways in which we habitually distract or undermine ourselves. As Gaynor suggests, the point is not to push for perfection, but to commit to habits that are sustainable and directionally correct. Paul Zapata, a hedge fund manager who was previously a commander in an elite counter-terrorist unit, SEAL Team 6, has thought hard about the necessity of focus. You have to know what your priorities are in life, he says. For me, it's God, family, fund. In that order. That clarity helps him to decide how to spend his time and energy so he's aligned with what matters most to him. Even this conversation is sort of outside of that alignment because it doesn't fit into the family fun God thing, he says. But it's okay to have that. You just have to make sure that it doesn't throw you off your priorities, that it doesn't affect your life. Is that too extreme? But most people make the mistake of adding too much complexity to their lives. They skim the surface, preoccupying themselves with the superficial and the extraneous. As the best investors show, sustained excellence requires us to subtract and go deep. Chapter 8. Don't be a fool. How to invest better, think better, and live better by adopting Charlie Munger's strategy of systematically reducing standard stupidities wherever the fool walks. He reveals to everyone that he is a fool. Ecclesiastes 10:3. To be wise, one must study both good and bad thoughts and acts, but one should study the bad first. You should first know what is not clever, what is not just, and what is not necessary to do. Leo Tolstoy. A calendar of wisdom. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. Charlie Munger. I have traveled 3,000 miles for a 10-minute interview with Charlie Munger. I arrive an hour early for my audience with him and wait in a state of nervous excitement to be summoned. It's February 15, 2017, and he is here in downtown Los Angeles for the annual meeting of the Daily Journal Corporation. Munger, who is the chairman of this obscure newspaper publisher, is better known as Berkshire Hathaway's billionaire vice chairman and Warren Buffett's partner for more than 40 years. Born in 1924, he is one half of the greatest investment team that ever lived. Munger has agreed to speak with me in private shortly before the Daily Journal meeting begins. So I'm standing outside a conference room in the company's nondescript headquarters, watching as the lobby fills with hundreds of his devotees, including prominent investors such as Lilu Monish Pabrai, Francois Rochon, Whitney Tilson, Christopher Davis, and Francis Chu. It's a running joke that almost nobody here cares about the Daily Journal. When attendees enter the building, they sign into a book that asks how many shares they own. For almost all, the answer is 0. Like me, they have come from far and wide to bask in the caustic wit and wisdom of this 93-year-old icon. The prospect of interviewing Munger is both thrilling and unnerving, given his reputation as a fearsomely clever curmudgeon who detects flaws and failings with devastating clarity. Buffett once declared, "Charlie can analyze and evaluate any kind of deal faster and more accurately than any man alive. He sees any valid weakness in 60 seconds." Buffett has also said that Munger boasts the best 30-second mind in the world. He sees the essence of everything before you can even finish the sentence. Microsoft's co-founder Bill Gates has said that Munger is the broadest thinker I have ever encountered. Munger's mind inspires awe among people who are not normally inclined toward hero worship. Pabrai, who claims that Munger is a quantum leap above Warren in terms of intelligence, chuckles at the memory of hearing him speak on stage alongside a Nobel Prize-winning scientist who was Caltech's biggest brain. That guy looked like a shrimp who didn't know shit. You could see the contrast, dumbass on one side, real brain on the other. Pabrai adds that Munger's innate gifts gave him a huge head start, which he's extended by synthesizing several books a week, roving voraciously over a multitude of disciplines. That combination of incredible wiring and intense data input makes it appear like the guy has been living for 300 years. But there's another reason to feel trepidation as I gird myself to meet Munger. Even his most ardent admirers will admit that he can be brusque to the point of rudeness. Chia laughs as he tells me the tale of a fellow money manager who traveled regularly to Omaha and California to hear Munger speak. One day, says Chu, this friend of his ran into Munger in an elevator and exclaimed, "Charlie, you've been such an inspiration to me. I've learned so much from you over so many years." Munger dismissed him with a single word, "So?" And then he walked away. Bill Miller recalls running into Munger on a street in New York. I said, "Charlie," and he looks at me and says, "Who the hell are you?" Miller introduced himself and reminded Munger that they'd once met at a behavioral finance event. He's like, "Oh yeah," and he said to his wife, "Why don't you go on to the hotel and I'll walk around with Bill for a while?" We probably walked around for an hour just talking about stuff, but it was funny. Who the hell are you? But my favorite story of Munger's flamboyant failures in diplomacy comes from Buffett, who shared it with Pabrai and Guy Spire over lunch in 1928. Munger, who has a glass eye, visited the Department of Motor Vehicles, where a hapless bureaucrat made the unfortunate error of asking him, "Do you still have just one good eye?" Munger replied, "No, I've grown a new one." Pabrai had assured me that Munger is kinder and gentler than his reputation might suggest. Charlie is a very soft, caring guy. He has a hard exterior, but once you get past it, he's a beautiful person. Munger's daughter, Molly, who is a lawyer and a philanthropist, adds that he has mellowed. He has an acerbic edge. I think when he was younger, it was more pronounced. Nonetheless, I took the precaution of preparing obsessively for our brief encounter, and what I began to realize while poring over decades of his speeches, writings, and other musings is that Munger adopts one practice that all of us would be wise to clone. He strives consistently to reduce his capacity for foolish thinking, idiotic behavior, unoriginal error, and standard stupidities. For example, at another shareholder meeting back in 2015, he ridiculed the popular delusion in academic circles that the market is so efficient that nobody can beat it. "I knew it was bullshit," he said, adding that he also Never believed there was a talking snake in the Garden of Eden? I had a gift for recognizing twaddle. I don't have any wonderful insights that other people don't have. I just have slightly more consistently than others avoided idiocy. Other people are trying to be smart. All I'm trying to be is non-idiotic. I find that all you have to do to get ahead in life is to be non-idiotic and live a long time. It's harder to be non-idiotic than most people think. It's a curious paradox that one of the smartest people on earth focuses primarily on avoiding stupidity. But as we shall see, this is an extraordinarily effective strategy in markets and life. The Non-Idiot's Guide to Life. The door to the conference room opens, and Munger greets me in a low, croaky voice. "Nice to see you. Sit down." I find myself sitting almost knee to knee with the sage. Several people are talking noisily as they leave the room, but Munger has no trouble tuning out the hubbub and focusing. He has white hair and powerful spectacles. His dark suit looks baggy on his thin and frail body. To my relief, his manner is surprisingly benevolent. There's no time for small talk, so I cut straight to the chase. I tell Munger that I regard him as the Grand Master of Stupidity Reduction, and ask him why he focuses so much attention on avoiding common errors and predictable patterns of irrationality. "Because it works," he says. "It works. It's counterintuitive that you go at the problem backward. If you try and be smart, it's difficult. If you just go around and identify all of the disasters and say, 'What caused that?' and try to avoid it, it turns out to be a very simple way to find opportunities and avoid troubles." Munger's approach of solving problems backward was influenced by Carl Gustav Jacobi, a 19th century algebraist who famously said, "Invert, always invert." But Munger tells me that he also honed this mental habit of inversion with help from his friend Garrett Hardin, an ecologist who shared his fascination with the dire repercussions of shoddy thinking. Hardin's basic idea was, if somebody asks you how to help India, just say, "What could I do to really ruin India?" And you think through all of the things you could do to ruin India, and then you reverse it and say, "Now, I won't do those." It's counterintuitive, but it really helps you to reverse these issues. It's a more complete way of thinking a problem through. In 1986, Munger delivered a commencement speech at a Los Angeles prep school, attended by several of his 8 children and stepchildren. Instead of trotting out the usual bland platitudes about the secrets of success and happiness, he provided an inspired illustration of how to apply the principle of inversion. He gave the students a series of prescriptions for guaranteed misery in life, recommending that they should be unreliable, avoid compromise, harbor resentments, seek revenge, indulge in envy, ingest chemicals, become addicted to alcohol, neglect to learn vicariously from the good and bad experience of others, cling defiantly to their existing beliefs, and stay down when struck by the first, second, or third severe reverse in the battle of life. When I ask Munger how to apply this method of thinking to practical problems, such as deciding whether to get married or buy a particular stock, he recommends asking, "Is this going to be a disaster?" instead of asking, "Is it going to be wonderful?" Finding out what's wrong and trying to avoid it is different from finding out what's good and trying to get it. You have to do both, of course, in life. But this inversion of looking for the trouble and trying to avoid it keeps you out of a lot of messes. It's a precaution. It's like a checklist before you take off in an airplane. Similarly, if you're looking to make a thoughtful investment in a well-managed fund, you might start by asking, how can I invest blindly in a lousy fund that's a disaster waiting to happen? That question would lead you to list all of the pitfalls that investors routinely overlook. For example, outrageous fees, dangerous exposure to the most popular and priciest sectors of the market, and a recent streak of head-spinning returns that will almost surely prove unsustainable. This, then, is the first mental trick we should learn from Munger as a safeguard against stupidity. Imagine a dreadful outcome. Work backward by asking yourself what misguided actions might lead you to that sorry fate, and then scrupulously avoid that self-destructive behavior. Of course, says Munger, a lot of people are so interested in reaching for the prize that they don't even think about the stupidities that might prevent them from getting it. Buffett and Munger have used inversion to avert many predictable and unpredictable disasters. Writing to Berkshire shareholders in 2009, Buffett discussed the art of inversion at length under the heading, "What We Don't Do." For example, Charlie and I avoid businesses whose futures we can't evaluate, no matter how exciting their products may be, sticking instead with businesses whose profit picture for decades to come seems reasonably predictable. Berkshire also holds vast quantities of cash, negating any need to be a supplicant in times of economic distress. Buffett also joked that this inversion approach works on a less lofty level. Sing a country song in reverse, and you will quickly recover your car, house, and wife. Like Buffett and Munger, all of the best investors I've encountered have extreme clarity about what not to do. Joel Tillinghast, who has beaten the Russell 2000 index by 3.7 percentage points a year since 1989, as the manager of Fidelity's low-priced stock fund, has been called the most gifted stock picker of his generation by Jim Lowell, editor of the Fidelity Investor newsletter. During an interview in Boston, I asked Tillinghast to explain his winning strategy. He responded by listing everything that he avoids. For example, he steers clear of development-stage biotech stocks, knowing that they're likely to bring out the worst in him. He can't make a valid earnings forecast because their future is so murky. Plus, biotech stocks are so volatile that they could trigger him to react emotionally. I'm going to be crazy if I deal with biotech stocks, he says, so I'm not going to do biotech stocks. Tillinghast, a shy and timid math whiz who manages more than $40 billion in assets, has developed a plethora of defensive principles and practices which have helped him to outperform and outlast almost all of his competitors. For a start, he says, don't pay too much. Don't go for businesses that are prone to obsolescence and destruction. Don't invest with crooks and idiots. Don't invest in things you don't understand. Tillinghast also steers clear of businesses that are deeply cyclical, heavily indebted, or faddish. He views promotional management and aggressive accounting as red flags. He shuns areas where he has no special insight or skill, because nothing is more critical than staying away from your ignorance. He also refrains from talking too publicly or too frequently about his holdings, because that would make it harder to change his mind and admit when he was wrong. And he resists the urge to trade stocks actively, since that would generate onerous transaction costs and taxes, which would erode his returns. What's left once he's eliminated all of those common causes of disappointment? A portfolio packed with undervalued, understandable, financially stable, profitable, and growing businesses run by honest people. His most amazing stock, Monster Beverage, has risen 1,000-fold. Following Tillinghast's example, we can all benefit from understanding the most popular recipes for failure. Think about why most investors mess up and, like him, don't do that. If you want to be superior, that's difficult, he says. But what you won't do is easier to control and more attainable. I'm not going to lose 15 pounds, but saying no to donuts, that's easy for me. Finally, it's worth noting that Munger's method of solving problems backward is also an effective way to avert self-inflicted chaos in our personal lives. Markel's co-CEO Tom Gaynor offers the example of a husband who ventures out on the town without his wife. I'm married to a lovely woman, he says. To be in a bar without her by myself under the influence of too much alcohol creates a different set of temptations and circumstances than would be the case with being more moderate. He recommends applying the Munger inversion technique by asking a simple question. What would be a bad thing, and how do I avoid that? A reasonable answer, says Gaynor, would be to have 2 drinks instead of 10. Whether your goal is to be a terrific stock picker or a terrific spouse. It's helpful to start by asking yourself how to be a terrible one, and then always invert, the collector of inanities. While other billionaires collect art, vintage cars, and racehorses, Munger describes himself as a collector of absurdities, assigninities, and inanities. His daughter Molly recalls listening in her youth to his many cautionary tales about people doing stupid things, which often included a tinge of ingratitude and poor moral judgment. A typical story would feature the cosseted heir to a fortune who turned with bitter resentment against his father. Molly Munger remarks, "It's stupid at every level. Ungrateful, self-sabotaging, unrealistic, egotistical." This habit of actively collecting examples of other people's foolish behavior is an invaluable antidote to idiocy. In fact, it's the second great anti-stupidity technique we should learn from Munger. It's a perverse hobby that provides him with endless entertainment and insight, enabling him to catalog in his head all of the boneheaded moves to excise from his playbook. Anyone can benefit from this practice, he tells me, but I don't think you get it unless you have a certain temperament. A lot of what I do is not IQ, it's something else. But I think it's partly inherited, like quick hand-eye coordination or a capacity in tennis. Munger is spoiled for choice when it comes to collecting investment inanities. For example, he derides the tendency to listen to market predictions, comparing these feeble attempts at financial divination to the ancient art of inspecting sheep's entrails to foretell the future. Another common error is to buy a cyclical company at the top of the cycle. A lot of people just do it all the time, and the investment bankers, of course, will encourage them to buy a dumb thing that will give a commission. These naive investors fail to realize that the old cyclicality is going to come back, trusting instead that the company's upsurge will keep going just because it's been going. That's a standard stupidity. Munger also collects examples of his own idiocy. When I attended Berkshire Hathaway's annual meeting in 2017, he spoke candidly about two of the costliest mistakes of omission that he and Buffett have made. Munger confessed to the audience of some 40,000 Berkshire shareholders that, "We failed you by not buying Google. We blew Walmart too, when it was a total cinch." Most of us prefer to bury our mistakes far from public view. We're not keen on admitting them to ourselves. But as Munger sees it, the more transparently he reviews his mistakes, the less likely he is to repeat them. He once told Berkshire shareholders, "I like people admitting they were complete stupid horses' asses. I know I'll perform better if I rub my nose in my mistakes. This is a wonderful trick to learn." Indeed, it's the third trick we must learn from him in our campaign to constrain our own stupidity. Still, Munger doesn't engage in gratuitous self-flagellation. He acknowledges his errors, learns the lessons, and moves forward without wallowing in regret. "We were active enough so we had some mistakes to remember," he says. "We learned a lot vicariously because it's so much cheaper. But we also learned a lot from unpleasant experience. Some of Berkshire's mistakes have stung, including its 1993 purchase of Dexter Shoe Co., which was annihilated by low-cost Chinese rivals. But none of those errors have been catastrophic in the grand scheme. No investor I've met has internalized the importance of avoiding catastrophe more deeply than Fred Martin, the founder of a Minneapolis-based firm called Disciplined Growth Investors. It's a priority that pervades every area of his life, from managing money to flying his private plane. Like Munger, Martin has made it a central focus to dissect other people's errors. "You don't have to do it with a sense of thrill," he says. "It's just to learn." For Martin, this way of thinking began as a survival strategy during 4 years as a U.S. Navy officer in the Vietnam War, a searing experience that showed him the devastating consequences of preventable mistakes. Martin joined the Navy in June 1969 after graduating from business school at Dartmouth. That month, an American destroyer, the USS Frank E. Evans, collided with an Australian aircraft carrier in the South China Sea. It was 3 o'clock a.m., and the destroyer's commanding officer was asleep. leaving two inexperienced lieutenants in charge. The ship turned the wrong way, straight into the carrier's path, and was cut in two. The front half of the destroyer sank in minutes, with much of the crew trapped inside. In all, 74 people died. 4 officers were court-martialed. An investigation concluded that the tragic event can be ascribed to error in individual human judgment. Martin still remembers the horror he felt while staring at a photograph of the vessel's severed remains. It's a shocking picture, because the ship stops about halfway. It's literally like a welder took a torch and just cut off half of the ship. But what made the catastrophe unforgettable was that it could have happened to him. Martin was promoted to lieutenant on another destroyer and became one of the most junior officers in naval history to be cleared for command at sea. At 24, he was responsible for 240 lives whenever his captain was asleep. How could he forget the 2 luckless lieutenants on the Frankie? Those poor kids whose mistakes sank their ship. Night after night, Martin stood watch when he was exhausted from lack of sleep. The ship's radio would be blaring. The engine room would be calling him about some problem or other. And they were steaming in the dark through treacherous waters. The situation was ripe for terrible mistakes, he says. Man, you were tired. You were just trying to survive. One habit that he developed was to walk out on the wing of the bridge whenever his ship was about to turn, so he'd confirm with his own eyes that the course was clear. That simple rule, that you must look before you turn, was not part of our training, says Martin. But it should have been. Looking back now in his 70s, he realizes how ingrained in him that wary attitude became. Martin left the Navy in 1973. I came out deadly serious, he recalls. The stock market had long intrigued him. He'd bought his first stock when he was 12, and even had a subscription to the Wall Street Journal delivered in infrequent batches to his ship. So he found a job as an equity analyst at a bank in Minneapolis. It didn't take long to discover that most members of his new profession lacked the vigilance that had protected him and his shipmates in wartime. His own father, a successful stockbroker with a talent for sales, lost $500,000 that year when the brokerage firm that employed him went bust. He'd staked a reckless portion of the family's wealth on that one business and missed all the warning signs that it was falling apart. Several years later, his father made a tidy profit on a stock that Martin had recommended. When they spoke about it on the phone, Martin recognized in a moment of awful clarity that his father was a wonderful man, but a terrible investor, hyperactive, impulsive, always looking for the quick hit. He was too excited, so I realized that he didn't know what he was doing. Martin's investment career began at a time of mass excitement when rationality was in short supply. Led by the Nifty 50, the market went nuts in 1973, and he saw that valuations had become unhinged from reality. He recalls analyzing a hot stock with no earnings and telling his boss that he saw little value there, and he said, don't worry about it, Fred. It's a faith stock. Of course, the stock gets destroyed. When the market collapsed in 1974, all the hotshots were washed out of the business, says Martin. But he could see that the relationship between price and value had now swung to the opposite extreme. It was an incredible buying opportunity. All you had to do was have the guts to invest. As a devout saver, he had the cash to buy a slew of bargain stocks, including Flight Safety International, my first 10-bagger. Those formative experiences of market folly reinforced the lesson that Martin had learned at sea. Nothing matters more than averting obvious errors, with the potential for catastrophic consequences. But in the decades that followed, he would observe the same pattern again and again, heedless risk followed by unnecessary disaster. For example, during the internet and telecom craze of the late 1990s, some of his clients jumped ship and invested a major portion of their life savings with Jim Olschlager, a gunslinging tech evangelist who at his peak attracted more than $400 billion in market value. As Martin had feared, gung-ho investors who were overexposed to such ultra-aggressive funds were immolated. Another client phoned to ask if Martin could guarantee a 12% return every year without fail. Martin told him that stocks are too volatile to promise that level of consistency, and he said, "Oh, a guy in New York, a genius named Madoff. Won't tell anybody how he does it, but he does 12% like clockwork." So the client entrusted his savings to Bernie Madoff, operator of the biggest Ponzi scheme in history. The lesson? If people can't tell you how they do it, and you can't understand what they do, says Martin, that's probably not the best spot to be in. His golden rule for risk management is simple: know what you own. As Martin sees it, the best defense against disaster is to understand the core principles of investing and then have the basic discipline never to violate these financial laws of gravity. The most essential law is always to maintain a margin of safety, which stems from buying assets for less than they are worth. Martin, who co-authored a book titled Benjamin Graham and the Power of Growth Stocks, warns you're going to screw up. The question is, can you recover? Graham's concept of the margin of safety helps you to contain your mistakes, so they're not too big. That's how you recover. Martin isn't advocating that we avoid risk. On the contrary, you need to take risks if you're going to achieve returns. But they should always be considered risks. Martin, who manages $15 million to open a separate account, specializes in a racy niche, small and mid-sized companies growing at a rapid rate. But he insists on investing at cheap or fair prices, based on his estimate of their intrinsic value now and in 7 years. It's an article of faith that a company's intrinsic value and its market value will converge over time. There are two sources of return for a stock, he says. One is the growth in intrinsic value. The other is the truing up between the stock price and the real value of the underlying business. He has no idea when that truing up will occur, but his average holding period is a decade. Martin will buy a stock only if it's cheap enough to generate a high expected rate of return over the next 7 years. For mid-cap stocks, he requires a minimum rate of return of 12% a year. For small caps, which have a greater risk of failure, he requires a minimum of 15% a year. Why does this matter? Because those standardized requirements force him systematically to buy stocks only when they are a sufficiently attractive proposition. As Martin learned in the Navy, adherence to process is an indispensable safeguard. Always honor it because that's going to keep you out of trouble. This idea of adopting a few standard practices and unbendable rules is our fourth technique for reducing stupidity. Buffett and Munger may not need formal constraints to maintain their discipline, but you and I are not them. Martin has another rule that he observes religiously as a protection against calamity. He never invests more than 3% of his assets in a stock at the time of purchase. Typically, he owns 45 to 50 stocks. Is that too conservative? But it hasn't prevented him from beating the indexes by a wide margin over decades, and it has prevented no end of misery. Just consider the case of Bill Ackman and Bob Goldfarb, two gifted investors who made colossal bets on Valeant Pharmaceuticals. The company lost 95% of its value amid scandals over its deceptive accounting and obscene overpricing of drugs. Goldfarb, who had more than 30% of the Sequoia Fund riding on Valeant, retired ignominiously, his illustrious record ruined by one mistake. Ackman lost $14 million to $500,000 worth of gorgeous office furniture from the defunct firm for $25,000. Let's never forget, he says, the value of being the last man standing. Beware of your brain. One of the thorniest problems we face as investors is that the human brain is ill-equipped to make rational decisions. Our judgment is frequently torpedoed by emotions such as fear, greed, jealousy, and impatience, by prejudices that distort our perception of reality, by our susceptibility to serpentine sales pitches and peer pressure, and by our habit of acting on flawed or incomplete information. As the evolutionary biologist Robert Trivers writes in The Folly of Fools, the logic of deceit and self-deception in human life. Our marvelous organs of perception enable us to obtain information that our minds systematically degrade and destroy In the 1990s, Munger confronted this problem in 3 speeches about the psychology of human misjudgment. In 2005, he wrote an expanded version for inclusion in a collection of his greatest hits, Poor Charlie's Almanac, The Wit and Wisdom of Charles T. His talk, which Nick Sleep hails as the finest investment speech ever, is a dazzling display of intellectual chutzpah. Munger, who'd never taken a psychology course and had read 3 textbooks on the subject, compiled a list of 25 psychological tendencies that cause our minds to malfunction, giving them evocative names such as excessive self-regard tendency, twaddle tendency, and simple, pain-avoiding psychological denial. He even had the temerity to criticize academic psychologists for failing to understand their own subject. Munger's compilation of standard thinking errors provides him, and us, with a practical checklist of pitfalls to avoid. The trick here is to first understand them and then train yourself out of them, says Sleep. Articulating this stuff is easy. Internalizing it is not. That's the hard work. But it's essential because the most enduring advantages are psychological. Munger starts with a tendency of such importance that almost all of us underestimate its significance. The role that incentives play in changing cognition and behavior. He quotes his hero, Benjamin Franklin, who said, "If you would persuade, appeal to interest and not to reason." Munger writes, "This maxim is a wise guide to a great and simple precaution in life. Never, ever, ever think about something else when you should be thinking about the power of incentives." Incentives are pivotal in every area of life, whether it's motivating employees or cajoling the most recalcitrant of adversaries, your children. Munger notes that the Soviet Union suffered from its communist leaders' foolish and willful ignorance of the superpower of the rewards, which led them to disincentivize much productive work. He also warns about the incentive-caused bias of salespeople, which can lead a pretty decent fellow to drift into immoral behavior in order to get what he wants. As an antidote, Munger offers this tip: especially fear professional advice when it is especially good for the advisor. The financial world is so riddled with conflicts of interest that we should always be wary of the mind-warping influence of incentives on anyone peddling products or advice. If, say, you're thinking of buying a fund or an annuity, you need to know precisely how your advisors are rewarded for their recommendations. It's equally imperative to assess whether a fund manager's incentives are adequately aligned with your best interests. In 1998, I wrote a damning article about the Kaufman Fund, which had hit the jackpot as a small fund making big bets on tiny stocks. Stellar returns and relentless advertising transformed it into a different beast, with nearly $186 million in fees over 3 years. Despite lagging the S&P 500 by more than 50 percentage points, one even admitted to me that he had none of his own money in the fund. That's misalignment. All these years later, I'm not shocked to see that the fund still charges an egregious expense ratio of 98% a year. With $400 million, that self-restraint has cost him tens of millions in fees, but it has served his existing clients admirably. It's always revealing to see how investors structure their incentives. As vice chairman of Berkshire, which has a market value of more than $100,000. As chairman of the Daily Journal, he receives no salary. He profits from performance, not fees. Munger often remarks on how critical it is to partner with honorable and unselfish people, while avoiding those with perverse incentives. He was appalled by the greed that precipitated the 2008-9 financial crisis, with Wall Street's best and brightest engaged in exploits such as repackaging subprime mortgages to create pestilent bonds with pristine credit ratings. It's easy to rationalize tawdry behavior, especially when it's legal and others are feeding from the same trough. But Munger recommends a higher moral standard, which involves saying, "This is beneath me." Another cognitive danger that Munger highlights in his speech is the tendency to quickly remove doubt by rushing to make a decision, a habit that's often triggered by stress. This doubt avoidance tendency makes evolutionary sense. given that our ancestors had to act decisively in the face of urgent threats. But mental shortcuts that lead investors to make impetuous decisions often end in disaster. To make matters worse, we also fall victim to what Munger calls inconsistency, avoidance tendency, which inclines us to resist new information and insights that might challenge our conclusions, no matter how hastily we reach them. Munger provides a vivid analogy. When one sperm gets into a human egg, there's an automatic shutoff device that bars any other sperm from getting in. The human mind tends strongly toward the same sort of result. The reluctance to re-examine our views and change our minds is one of the greatest impediments to rational thinking. Instead of keeping an open mind, we tend consciously and unconsciously to prioritize information that reinforces what we believe. The mistake of clinging blindly to our existing convictions can be exacerbated by several other psychological tendencies. Excessive self-regard tendency leads us to overestimate our talents, opinions, and decisions. Over-optimism tendency lures us into careless acts of financial hubris, especially when all is going well and we're feeling clever. And simple, pain-avoiding psychological denial causes us to distort facts when the reality is too painful to bear. That helps to explain why so many investors fool themselves into believing that they can outpace index funds in the long run, despite lacking the requisite skills, temperament, or control over costs. Munger likes to quote the ancient Greek orator Demosthenes, who observed, "Nothing is easier than self-deceit, for what each man wishes, that he also believes to be true." If the human mind is such a dirty trickster, how can we expect to make rational investment decisions? First, we need to acknowledge that this insidious threat exists. As Ben Graham wrote, the investor's chief problem, and even his worst enemy, is likely to be himself. We also need to be wary of our own distinctive psychological tendencies, which can skew our judgment in predictable directions. Howard Marks, who is inclined to worry, tells me, if your thinking is heavily colored by wishful thinking, then your probability assignments will be biased toward favorable. If you're given to fear, then you'll be biased toward the negative. No one is going to say, this is my prediction and it's probably wrong. But you must say, this is my expectation, and I have to be aware of the likelihood that it's colored by my emotional bias. And you have to resist it. For me, that means not to chicken out when the going gets tough. One way that Munger guards against irrationality is by emulating the extreme objectivity of scientists such as Charles Darwin, Albert Einstein, and Richard Feynman. When I ask what we can learn from them about how to think through a problem, Munger says, they were all very hard on themselves. They worked at reducing stupidity. They cared about thinking it through properly. They had long attention spans, and they worked to avoid the stupidities. Munger particularly admires their unflinching determination to seek out disconfirming evidence that might disprove even their most cherished beliefs. This mental habit, which takes many different forms, is our fifth defense against idiocy. For example, Darwin refused to allow his Christian faith, or the conventional wisdom among his fellow naturalists, to impede his shocking conclusions about evolution. In the introduction to his 1859 book on the origin of species, he discards a sacrosanct belief drawn from the Bible, declaring, "I can entertain no doubt, after the most deliberate study and dispassionate judgment of which I am capable, that the view which most naturalists entertain, and which I formerly entertained, namely, that each species has been independently created, is erroneous. That willingness to welcome the discovery of our own errors is an inestimable advantage." Munger nurtures it by applauding himself whenever he succeeds in demolishing one of his entrenched beliefs, so that ignorance removal becomes a source of satisfaction, not shame. He once remarked, "If Berkshire has made modest progress, a good deal of it is because Warren and I are very good at destroying our own best-loved ideas. Any year that you don't destroy one of your best-loved ideas is probably a wasted year. One year stands out because the best-loved idea they destroyed made way for an even better idea, which would alter Berkshire's course dramatically over the next 5 decades. In 1972, Buffett and Munger were presented with the opportunity to acquire See's Candies, a Californian maker of chocolate, for $25 million bid. Munger has said that he and Buffett would have walked away from See's if the price had been $2 billion in pre-tax profits, vindicating their new belief that it's worth paying more for great businesses. That realization changed everything, leading them to invest in world-class companies such as Coca-Cola. Their appreciation for intangible assets, including brand loyalty and exceptional management, has continued to evolve, allowing them to pay even richer premiums to acquire unique businesses such as eScar and Precision Castparts. In his 2014 annual report, Buffett credited Munger with curing him of his addiction to cigar butts and establishing the design of today's Berkshire. The blueprint he gave me was simple. Forget what you know about buying fair businesses at wonderful prices. Instead, buy wonderful businesses at fair prices. None of this would have happened if Buffett and Munger weren't so committed to challenging their beliefs. Munger has always disdained heavy ideology, in everything from investing to politics, denouncing it as one of the most extreme distorters of human cognition. Having practiced law before Buffett persuaded him to change professions, Munger consciously trained himself to study counter-arguments so he can articulate them as accurately as if they were his own views. He also makes a point of reading articles by cogent thinkers with whom he disagrees, including the New York Times columnist Paul Krugman. Most of us favor media sources that echo our social and political prejudices, but Munger's example led me to adopt a simple, mind-expanding practice of reading columns in the Wall Street Journal that counter my own biases. Another practical way to ensure that our weak ideas and lazy prejudices don't go unchallenged is to find intellectual sparring partners who aren't afraid to disagree with us. Buffett once observed, "What the human being is best at doing is interpreting all new information, so that their prior conclusions remain intact." That is a talent everyone seems to have mastered. And how do we guard ourselves against it? His answer: a partner who is not subservient and who himself is extremely logical is probably the best mechanism you can have. Munger, the ideal foil, has shot down so many investment ideas that Buffett refers to him as the abominable no man. Munger points out that one essential benefit of having a discussion partner is that it obliges you to organize your thoughts to make a persuasive case. Pabre recalls introducing Spire to Munger and telling him, "Charlie, this is the person I bounce all my ideas off." Spire joked that he's so dumb that Pabre might as well talk to a monkey. And Charlie immediately says, the monkey would not work. He was very serious. This was like Moses giving the 4th commandment. He said, the monkey would not work because Monish would know it's a monkey. Other leading investors have found additional ways to ensure that they remain open to divergent views. Bill Nygren, a renowned fund manager at Harris Associates in Chicago, recalls meeting Michael Steinhardt, a hedge fund billionaire who would invite 2 Wall Street analysts into his office, the biggest bull and the biggest bear, and the 3 of them would argue about an idea over lunch. He always wanted to know what the most bearish people thought of something before he would buy it, or what the most bullish people thought before he would short it. Inspired in part by Steinhardt, Nygren conducts a devil's advocate review before buying any stock. One analyst on his team presents the bullish case. Another is tasked with putting together the strongest bearish case. By better understanding what we're betting against, we're more likely to make the right decision. Nygren knows that it's even harder to think objectively about a stock once he owns it. That's partly because of the endowment effect, a cognitive bias that makes us value what we own more highly than what we don't, whether it's a stock or a beer mug. One way that Nygren counteracts this bias is by also performing devil's advocate reviews for each of his biggest holdings. At least once a year, a team member reassesses the stock in question and is given the responsibility of arguing why it should be sold. Another psychologically astute strategy is to perform a premortem before making any significant investment decision. That's to say, you project into the future and ask yourself a hypothetical question. Why did this decision prove to be such a disaster? The notion of a premortem was devised by an applied psychologist, Gary Klein, to identify problems in advance and reduce the risk of overconfidence for investors. It's a valuable safeguard because it forces us to dwell on unfavorable facts and latent threats as a formal step in the decision-making process. In 2016, I audited the Advanced Investment Research course at Columbia Business School, which was taught for a decade by Ken Schubinstein, a friend who was then the chairman of an investment firm called Spencer Capital Holdings. Schubinstein, who qualified as a doctor before becoming a hedge fund manager, instructed his MBA students to imagine themselves in 3 years' time, when an investment of theirs has failed, and to write a newspaper article explaining the cause of death. Another eminent investor told the class that his family office writes a pre-mortem memo as the final precaution before making any investment. The procedure exposes such serious concerns that he rejects 1/3 of the investments he would otherwise have made. Nobody I've encountered is more thoughtful than Schubinstein about the defensive measures we can take to diminish the destructive effects of cognitive biases. It helps that his experience is so diverse. He spent 2 decades as a fund manager and built a holding company with more than 400 employees. But he's also steeped in science, having done research in molecular genetics, trained as a surgeon, and co-founded the International Concussion Society. His interest in the brain is so consuming that he quit the investment business in 2018 and became a neurologist. Schubinstein warns that you can't immunize yourself effectively against cognitive biases, no matter how smart or self-aware you are. The recognition that we are all subject to them is a start, but that knowledge doesn't protect us against their unconscious influence on our thinking. Still, he offers several practical suggestions that can significantly enhance our ability to make rational decisions. Despite the problematic tendencies ingrained in the human brain over millennia. For a start, Schubinstein recommends taking the time to rewrite the list of common cognitive errors that Munger describes in his talk on the psychology of misjudgment. Instead of quoting Munger, it's best to describe these pitfalls in your own words, so you can internalize his insights and make them your own. It's also helpful to personalize Munger's checklist by including investment mistakes you've made in the past and emphasizing the tendencies to which you're especially vulnerable. You need to learn how your own brain works, where you're strong, and where your challenges lie, explained Schubinstein. For example, he's highly susceptible to authority bias, which has sometimes led him to place too much faith in stocks owned by investment luminaries whom he admires. To help counter this bias, he added 2 questions to his cognitive checklist. Have I done the work? And have I independently verified everything? Like Munger, Schubinstein advocates a scientific approach to analyzing investments. That means adopting a mindset of falsification, always striving to disprove your hypothesis and seeing if it stands up to the assault. One of Schubinstein's favorite questions is, why might I be wrong? He also stresses the importance of analyzing alternative competing hypotheses, a methodology that he borrowed from Richard Heuer, a CIA veteran who wrote a classic book titled Psychology of Intelligence Analysis. Schubinstein told his students that they must never forget Heuer's insight that a single piece of evidence can support more than one hypothesis. One of Heuer's enduring contributions to the CIA was to develop a rigorous 8-step procedure for the simultaneous evaluation of multiple competing hypotheses. Few of us possess the patience to think through problems that thoroughly, but as Heuer suggests, we can't overcome our cognitive limitations unless we have a systematic analytical process that enables us to think methodically. Devil's advocate reviews conversations with a skeptical discussion partner, a cognitive checklist that reminds us of our biggest biases and our past mistakes. These are all disciplined analytical techniques that can help us systematically to slow down, open our minds, and consider risks that we might otherwise overlook. Similarly, Schubinstein taught his students to perform a bull-bear analysis for every company they analyzed. Another basic procedure that entails writing two thesis statements, one positive, one negative, each on a single page of its own. The key is to use such techniques routinely so we consistently challenge our assumptions, contemplate counter-arguments, and resist the brain's tendency to conserve energy by taking shortcuts. This emphasis on adopting systematic analytical procedures is the sixth strategy in our epic quest to be non-idiotic. Finally, we need a pragmatic way to protect ourselves from our emotions, given how grievously they can compromise our ability to make rational decisions. In his talk, Munger mentions how emotions such as stress, depression, hatred, and envy can cause dysfunctional thinking and accentuate our cognitive biases. For example, acute stress and confusion can intensify an investor's urge to follow the crowd and abandon independent thought. Especially when markets are plunging, the desire to seek safety in numbers makes evolutionary sense. But for investors, herd behavior is often disastrous, driving them to buy during bubbles and sell during panics. As Munger once remarked, crowd folly, the tendency of humans, under some circumstances, to resemble lemmings, explains much foolish thinking of brilliant men and much foolish behavior. In 2015, the Annual Review of Psychology published a survey of 35 years of scientific studies about the effects of emotion on decision-making. The authors write that the one overarching conclusion of all that research is that emotions powerfully, predictably, and pervasively influence decision-making. For example, researchers who studied gambling decisions found that sadness increased tendencies to favor high-risk, high-reward options, whereas anxiety increased tendencies to favor low-risk, low-reward options. In other words, our emotional disposition and moods routinely distort what we see and how we relate to risk. Based on such research, Schubinstein developed the precautionary habit of checking whether he's in the right psychological and physiological state to make decisions. This habit is immeasurably valuable not only in markets, but in every area of life where our decisions could have calamitous consequences. The scientific literature shows that hunger, anger, loneliness, tiredness, pain, and stress are common preconditions for poor decision-making. So Schubinstein uses an acronym, HALT-CEASE, as a reminder to pause when those factors might be impairing his judgment and postpone important decisions until he's in a state in which his brain is more likely to function well. 4. This is our seventh technique for reducing avoidable stupidity. During the 2008-9 financial crisis, Schubinstein suffered an agonizing trial by fire. Many of his fund's investors bailed out when they should instead have been buying. His business was in jeopardy, and he felt a deep sense of shame as he faced the first grave setback of his career. At the same time, two of his closest friends lost their daughter in a boating accident. It was such a traumatic period that it catalyzed him to build a healthier lifestyle that would help him to maintain his emotional equilibrium and think more clearly even under the most stressful conditions. There are 4 things that we know improve brain health and brain function, says Schubinstein. Meditation, exercise, sleep, and nutrition. Determined to use every tool at his disposal, he exercised strenuously, which also helped him to sleep better. He ate more fish, vegetables, and fruit. He renounced his worst tendencies, including a habit of handling stress by gorging on vanilla ice cream with mashed-up chocolate chip cookies. And he developed a regular meditation practice, a mission-critical habit for many successful investors. These practices for sustained high performance have a compounding effect when you use them consistently, says Schubinstein. For example, the reason you meditate is not because it's important on a specific day. The regular practice of meditation will help you handle the hard setbacks and will keep you constantly prepared for them. Having that practice in place prepares you well. It's a lot like preventative medicine. This is a critical nuance that I think most of us miss. The optimal time to adopt these healthy habits isn't when we're in the throes of chaos, but in advance. Once trouble strikes, says Schubinstein, the key is to recognize that our emotional state may be setting us up for failure. When he's stressed, upset, or overwhelmed, he tries to take a break, make sure that he's rested and well fed, and gives himself time to return to a neutral state that will allow for more mindful decision-making. Simple solutions such as clearing his schedule and sleeping on decisions for a night have also helped considerably. The more intense things get, the less I do, both personally and professionally, he says. I try to slow things down. I try to simplify life. I look at my calendar and withdraw from a lot of activities to make sure that I'm eating well, meditating, and have structured time to think and reflect. In 2020, Schubinstein served as a volunteer doctor in an intensive care unit filled with dying COVID-19 patients connected to ventilators. It literally felt like being in battle, he says. We were doing something important, but our lives were at risk, and we were putting our families at risk, which felt terrible. A few days earlier, his wife had given birth to their first child. He moved into a hotel to safeguard them. In the midst of this nightmare, Schubinstein drew on all of the habits that had helped him to handle his emotions during his investment career, including a nutritious diet, exercise, and small doses of meditation, which sometimes meant just breathing for 10 seconds in the bathroom before returning to the ICU. Above all, he tried to remain acutely aware of his internal state so that emotions such as fear, anxiety, sadness, anger, and loneliness wouldn't undermine his ability to care for his patients and communicate each day with their grief-stricken relatives. One incredibly helpful tool was his HALT PS checklist. He used it constantly to gauge his emotional condition and the debilitating effect of the physical pain that he felt while wearing personal protective equipment. Once you recognize that you're not at your best, says Schubinstein, you can consciously compensate. In the hospital, that meant taking additional care to double-check his decisions and pushing himself to be extra compassionate with patients. The challenges that he faced were extraordinary, but the overarching lesson applies to all of us. We, too, need the self-awareness and honesty to acknowledge when our emotional state is likely to compromise our judgment and our performance, so we can proceed with heightened caution. More broadly, we also need to construct a lifestyle that's conducive to calm resilience. Munger, for one, has spent inordinate amounts of time engaged in activities that instill a sense of balance and well-being. Whether it's reading books in his library at home, playing bridge with friends, golfing, or fishing. He also keeps an uncluttered schedule that leaves him ample space for contemplation. The details differ, but we all need habits and hobbies that foster equanimity. But the truth is, Munger doesn't struggle like most of us to keep his emotions in check. When I ask him if he agrees with Marx that all of the best investors are unemotional, he replies, yes. Does he ever fret about his investments or feel fearful so he doesn't have to work against those emotions because he doesn't experience them? In the absence of extreme emotional static, Munger has the freedom to focus with imperturbable detachment on whether the odds of an investment succeeding favor him overwhelmingly. When bank stocks went up in flames during the financial crisis, he concluded that Wells Fargo was so ridiculously cheap that it represented a once-in-40-year opportunity. He bought it on behalf of the Daily Journal at the bottom tick in March 2009, a perfect example, he says, of rationality and good sense. His lack of emotion is an innate advantage that few investors share. Warren is wired that way too, he says. We're quite similar in the way we're wired. Munger has also learned to control certain toxic emotions that would corrode his enjoyment of life. Crazy anger, crazy resentment. Avoid all that stuff, he tells me. I don't let it run. I don't let it start. The same goes for envy, which he considers the dumbest of the 7 deadly sins, because it's not even fun. He also disdains the tendency to view oneself as a victim, and he has no patience for whining. When I ask if he has a mental process that helps him to diffuse self-defeating emotions, he replies, I know that anger is stupid. I know that resentment is stupid. I know self-pity is stupid. So I don't do them. I'm trying not to be stupid every day, all day. Lessons of a lifetime. At the end of our interview, Munger retrieves his cane and hobbles slowly across the lobby of the Daily Journal's offices toward a makeshift stage. The audience breaks into sustained applause at the sight of him. He needs help to climb the 2 stairs onto the stage. Breathing heavily, he takes his seat and peers out with his one good eye at a room overflowing with his admirers. Many are obliged to stand because all of the seats are filled. More people are here than in previous years, he comments wryly, because they think it's their last chance. Part guru, part showman, Munger revels in this opportunity to share many lessons from his life. You're cult members, he says, with an air of affectionate amusement. You'll stay a long time because some of you have come a long way. Over the next 2 hours, he fields more than 40 questions, dispensing wisdom and wisecracks about everything from markets to marriage. Asked for career advice, he opines. You have to play in a game where you've got some unusual talents. If you're 5'1", you don't want to play basketball against some guy who's 8'3". It's just too hard. So you've got to figure out a game where you have an advantage. And it has to be something that you're deeply interested in. Asked about China, he marvels at its economic transformation, but laments that too many Chinese like to gamble. And they actually believe in luck. Now that is stupid. What you don't want to believe in is luck. You want to believe in odds. Munger has no interest in gambling at casinos or racetracks. If the odds are against me, he says, I just don't play. Asked about the crash of 1973-74, when his investment partnership lost more than 50%. He notes that Berkshire's stock price has also halved on 3 occasions. If you're going to be in this game for the long pull, which is the way to do it, you better be able to handle a 50% decline without fussing too much about it. And so my lesson to all of you is, conduct your life so that you can handle the 50% decline with aplomb and grace. Don't try to avoid it. It will come. In fact, I would say if it doesn't come, you're not being aggressive enough. Asked about diversification, he describes it as a fine rule for those who don't know anything. But his preferred strategy is to wait for rare opportunities where the probability of gain vastly outweighs the probability of loss. When they arrive, he grabs them with gumption. Munger confides that his family's 10-figure fortune rides almost entirely on 3 investments: Berkshire, Costco, and a portfolio of Chinese stocks selected by Lilu. The chances that any of those 3 bets will fail is almost 0, says Munger. Am I securely rich? You're damn right I am. Asked about index funds, he talks about the misery they've inflicted on much of the investment profession. The vast majority of active fund managers will fail to beat the index over time, which means they are scraping off fees as a reward for providing no added value. The honest, sensible people know they're selling something they can't quite deliver, says Munger. Most people handle that with denial. I understand that. I mean, I don't want to think of my own death. The crowd disperses after the shareholder meeting draws to a close, but Munger stays put. A couple of dozen faithful followers gather around him, and he spends 2 more hours answering questions. For sustenance, he opens a box of C's peanut brittle. He chomps on it joyously, crumbs flying everywhere, then shares the box with his delighted fans. I stand a few feet from his chair, observing him closely and occasionally asking questions of my own. What impresses me most is not just the range and agility of his mind, but the generosity of his spirit. I find it moving to see the patience, care, and kindness that this ailing master displays to his disciples. As Munger looks back on his financial adventures, it becomes clear that what he cherishes most is not the scale of his victory, but the manner in which he has won it. He recalls a time when he and Buffett gladly rejected the best deal we ever saw, the chance to acquire a manufacturer of snuff. There was just one hitch. The company made a fortune hawking an addictive product known to cause cancer. Undeterred, the Pritzker family bought this ugly gem and made a profit of about $3 billion. Still, Munger has no regrets. We are way better off not making a killing off of a product we knew going into it was a killing product, he says. Why should we do that? For Munger, the goal has never been to win at all costs. Money was very important to him, says his daughter Molly. But to win it by cheating or win it and lose the battle for life, that was never what he was about. In the foreword to Damn Right. A biography of Munger by Janet Lowe, Buffett writes, in 41 years, I have never seen Charlie try to take advantage of anyone. He has knowingly let me and others have the better end of a deal. And he has also always shouldered more than his share of the blame when things go wrong, and accepted less than his share of credit when the reverse has been true. He is generous in the deepest sense. Munger embodies an enlightened form of capitalism that is infused with old-fashioned values. For example, he disapproves of mean-spirited tactics, such as brutalizing suppliers by paying them late. My theory of life is win-win, he says. I want suppliers that trust me, and I trust them, and I don't want to screw the suppliers as hard as I can. But how does he reconcile his faith in fairness with the reality that many fortunes have been built in a less honorable manner? Munger responds by speaking about the multi-billionaire media tycoon Sumner Redstone, a famously shrewd and hard-driven tough tomato who amassed controlling stakes in Viacom and CBS. Almost nobody ever liked him, including his wives and his children, says Munger. Mein Gott! Sumner Redstone and I graduated from Harvard Law School about a year or so apart, and he ends up with more money than I did. So you can say he's the success, but that's not the way I look at it. And so I don't think it's just a financial game, and I think it's better to do it the other way. I use Sumner Redstone all my life as an example of what I don't want to be. When I ask Munger what we can learn from him and Buffett about how to lead happy lives, he talks about the quality of their relationships and the joy of partnering with decent, trustworthy people. Warren has been a marvelous partner for me. I've been a good partner for him. If you want to have a good partner, be a good partner. It's a very simple system, and it's worked very well. The same principle applies to marriage, too. If you want a good spouse, deserve one. Despite his best efforts, Munger has endured his share of suffering. His first son, Teddy, died of leukemia at the age of 9, a miserable, slow death. And in the end, he kind of knew it was coming, and I'd been lying to him all along. It was just pure agony. There was a divorce, too, and the loss of his eye, and the death of his second wife, Nancy, after 52 years of marriage. The idea that life is a series of adversities, and each one is an opportunity to behave well instead of badly, is a very, very good idea, says Munger. I think you take the hardships as they come. You take the blessings as they come. Have fun out of figuring out the puzzles as best you can. It also helps to have a sense of humor. One of the highlights of the daily journal meeting comes when Munger recalls his romantic failures as a short, skinny boy at Omaha Central High School 8 decades ago. In his freshman year, he invited a blonde goddess to a dance. Hoping to impress her, he pretended to be a smoker. She was wearing a net dress and I set her on fire, he says. But I was quick-witted and I threw Coca-Cola all over her, and in due time the fire was out. And that's the last I saw of the blonde goddess. Finally, after speaking for 5 hours straight, Munger is informed that he has another meeting to attend. I help him down from the stage, holding his arm to provide support. As he walks away, I am filled with a sense of awe. Today I have been in the presence of greatness. Epilogue, beyond rich. Money matters. But it's not the essential ingredient of an abundant life if all you succeed in doing in life is getting rich by buying little pieces of paper. It's a failed life. Life is more than being shrewd in wealth accumulation. Charlie Munger, a television reporter, once asked Bob Marley, "Are you a rich man?" The musician replied warily, "What do you mean rich?" The reporter clarified his question. "You have a lot of possessions?" A lot of money in the bank? Marley responded with a question of his own. Possessions make you rich. I don't have that type of richness. My richness is life forever. Over the last quarter of a century, I've spent an enormous amount of time interviewing and observing many of the world's leading investors, and I've frequently found myself pondering this question of what makes a person rich. In a superficial sense, these investors are the ultimate winners. They have hit the jackpot on an almost unimaginable scale, enabling them to buy palatial properties, yachts, planes, and world-class collections of everything from art to race cars. But what does their wealth actually do for them? How much bearing does it have on their contentment? And if their physical riches are not the key to true abundance, then what is? All those toys and trophies provide about as much joy as you'd expect. Some, but not that much. Sir John Templeton once wrote, "Material assets bring comfort, but help little toward happiness or usefulness." One of the real fallacies is the popular notion that happiness depends on external circumstances and surroundings. To a great extent, he was obviously right. You don't have to be an enlightened Zen monk to recognize that physical pleasures offer an ephemeral and unreliable route to happiness. Still, I would note that Templeton himself chose to live in a beautiful house in the sun-kissed Bahamas, surrounded by the super-rich. His choice suggests that external circumstances do have some influence on our sense of well-being. Ed Thorpe, a legendary gambler and investor who exudes joie de vivre, thinks with characteristic rationality about how best to structure his life in ways that improve his odds of being happy. One of his most life-enriching decisions was to buy a waterfront house in Newport Beach, California, with sublime views of sunsets over the Pacific Ocean. "It's just a prime place to enjoy oneself," says Thorpe. "Why do I want to live in a congested, madhouse city with smog and filth, and terrible weather and noise, and a struggle to get from one place to the next? I'll just live in a place where it's sunny and pleasant, and I can exercise outdoors, and I can enjoy a lot of beauty, and I can go on hikes, sail, and I can scuba dive." Thorpe, who started his career as a modestly paid math professor, appreciates the luxuries that investment success has afforded him. When I ask if he has any possessions that he loves, he grins and says, "I really enjoy my Tesla. It's so much fun. It's just the greatest car." Still, he was never seduced by the fantasy that he'd become even happier if only he could amass more money, more houses, more cars, more everything. "Who you spend your time with is probably the most important thing in life," says Thorpe, who was widowed after 55 years of marriage and has since remarried. People who just keep piling up stuff don't get that, and they end up with a whole lot of stuff at the end, but they've spent their whole life just chasing it. As Thorpe suggests, problems tend to arise when we become so consumed by the pursuit of money and possessions that we lose sight of what matters more. During his career as a hedge fund manager, Thorpe could easily have gouged his shareholders and pocketed more of the spoils. Instead, he asked himself what he'd consider fair and reasonable if he were the client. He then designed his incentives so he'd earn nothing unless his clients made a profit. People who don't care about other people and are willing to do inconsistent, outrageous things and rip other people off seem to have an edge, he says. But to me, it's maybe an edge in getting what they want. They can rip off more raw meat from the carcass of life, but they don't live well, and they don't realize it. And when it's all over, they've basically wasted their lives. All of this leads us to an important caveat. We need to be acutely aware of what we're willing and unwilling to sacrifice for the sake of money. This might include rich relationships with our family and friends, talents and ambitions that we neglect at the expense of our fulfillment. The time to relish experiences that don't advance us in a material way, or values that it's tempting and often profitable to violate. When I ask Thorpe if he has any regrets about the choices he's made in his life, he says, "I don't regret any of the principal choices I made." It's a reminder that one aspect of a successful and abundant life is the self-respect that comes from trying consistently, despite all of our flaws and failings, to behave decently and avoid harming others. The freedom to work until you are 109 years old. In 2015, Irving Khan died at the astonishing age of 109. He'd lived through 2 world wars, the crash of 1929, the Great Depression, the rise and fall of the Soviet Union, the invention of computers, and so much else. Benjamin Graham had been his mentor and friend, and had shared with him the secrets of intelligent investing. Khan had drawn that wisdom to build a respected investment firm, Khan Brothers Group, where he worked alongside his son Thomas and grandson Andrew. Khan was married for 65 years and had a busload of grandchildren and great-grandchildren, as I mentioned in a previous chapter. I typed out several questions for Khan a few months before he died and gave them to Andrew, who wrote down his grandfather's answers over several days. Above all, I wanted to know what had been the key to a meaningful and fulfilling life, and not just an extraordinarily long one. It's very hard